be everywhere, you'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality, and he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line, we'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah. So for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lines from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got the Dow, the S&P, NASDAQ all pushing higher right now. Choppy session, though, as investors assess prospects for earnings growth against a backdrop of rising interest rates. Treasuries are falling. We have got the S&P up right now by 53 points, gain there of 1.5%. The Dow is advancing 425, up 1.4%. NASDAQ up 138. That is a gain of 1.3%. The 10-year yield 4.01%. Spot gold up 0.1%, 16.52 the ounce. West Texas Intermediate crude down 2.8%, 83.02 a barrel. The Bank of England will start its delayed bond sales on November 1st, but initially will not include the long-dated debt that's been at the heart of recent market turmoil in the wake of the government's ill-fated fiscal plans. Kelsey Barrow is fixed income portfolio manager at J.P. Morgan Investment Management, and on Bloomberg Surveillance this morning, she told us she is definitely watching watching the Bank of England.
I think when I look at what's been happening in the gilt market, which has really been driving global market sentiment, the one thing that I really have taken away is that the BOE has never backed down. They are continuing on with QT. We think that's going to happen at the end of the month. And when we look at the big picture, the fundamental data in the U.S. is still suggesting that the Fed needs to continue to push on with rate hikes and QT.
Earnings fast and furious. Goldman Sachs after earnings up now by 3.1% expectations, but J&J shares down now by 0.1%. Apple has launched its first fully redesigned entry-level iPad in 5 years, and today we are looking at Apple shares up by 2%. Again, recapping, S&P up 52. That is a gain of 1.4%. I'm Charlie Pellet. That's
on Bloomberg Radio. Paul Sweeney, nice to have you here for the ride.
Great to be here. Always good day to market. So busy day with earnings. So we'll have lots to talk about.
We've got Netflix, which is something that you keep a watch
right.
on.
Literally and figuratively. So I do watch Netflix, but I've been watching that stock since its inception, and they have upended the media business to say the least. And now everybody's just trying to adapt.
All right, we're going to talk about that. We're going to also go through Goldman's earnings. They were out earlier this morning. We're going to talk about how the Fed is giving Americans a lesson in lag time. I got to say, Paul, I love this story.
Yes, and that's what economists have been telling us, which is when you raise rates, it doesn't happen immediately. The economy doesn't slow immediately, although the housing market seemed to be the first to turn, but you got to give it some time.
Exactly. So we're going to get into that. We're also going to talk about Facebook, a friend no more of Mark Zuckerberg. We got so much coming up, including a most read on the extraordinary rise and fall of the COVID billionaires. First up, though, let's get to the market drivers report. Let's set your Business Week agenda on this. Yes, it's Tuesday, Lemon. Kriti Gupta, anchor and markets correspondent at Bloomberg in our Interactive Brokers studio, and the amazing Gina Martin-Adams, chief equity strategist at Bloomberg Intelligence, on the phone from New Jersey. In fact, they're both amazing, and we learned so much about the markets. Kriti, let's kick it off with you. We're up, but we're certainly off our highs of the day.
Oh, you flatter. And you call me Lemon. I call everyone Lemon, but it's so sweet. It's like a spring or summer
it's
day.
so much nicer than with Matt Miller, isn't it?
Yeah, Matt Miller just comes on.
What does he do?
Matt Miller makes fun of me on the air. Today, what did he do today? He shamed me for having a meeting.
Yes.
And he says, Kriti's always in meetings, which I was like, all right, Matt. But it's something new every day. That's
our Matt Miller.
This is a breath of fresh air. Thank you, Carol.
You're welcome.
The S&P 500 seeing a fairly broad rally. I will say, though, this is not
Not as broad as yesterday?
Not as broad as yesterday, which is the caveat here. This is not the 2-3% rally you saw yesterday, but still 1.3% gains on the S&P 500 is nothing to scoff at all. If you were to look at an intraday chart, it almost looks like the stock market went negative, and really it's still up over 1%, which I think is interesting. It is, however, I think taking its cue more from the earnings stories than it is from the bond market or the dollar, which is interesting because in the past, I want to say a couple of weeks, arguably a couple of months, you've had this dynamic where the bond market and the stock market will be bid at the same time. And on a risk-off day, both will sell off, and the dollar will be stronger. That hasn't been the case today. In fact, you see stock market rallying and a 10-year yield where bonds have actually sold off, and the 10-year yield has gone above 4% at a time when the dollar is about flat. So I think to see that cross-asset divergence is the takeaway today.
Gina, I want to bring you in here. Earnings, they're starting to flow in. We've had some of the banks, and then we'll have Netflix today, the tech companies next week. What are you looking for from these companies here? Presumably some guidance would be helpful as we try to navigate what it means to operate in a post-pandemic world.
Yeah, certainly guidance would be helpful. Sort of the transition to the post-pandemic world, in particular for tech, is also very helpful. Recall these were some of the stocks that did they were the very best of the best performers during the midst of the pandemic, and a lot of what's happened over the last year has been sort of this waterfall decline in performance coming back to some sort of new kind of reality. And that certainly has created a significant degree of pressure on prices as well as the earning streams for these companies. So how are they transitioning? How are they preparing for a new post-pandemic world? And what will that mean for the earnings outlook is pretty important for tech. For the rest of the groups, it's really about kind of how is the economy evolving? How are you navigating the environment of higher interest rates, still sticky price inflation, but generally slowing activity is a huge question mark for going into 2023. In the short term, though, it really is about the beat. I think we've been through this game before many, many times, and especially in the midst of periods of macroeconomic uncertainty, stocks do tend to very strongly embrace earnings cues. So in the midst of earnings seasons like we saw in second quarter, as long as companies are beating expectations, prices generally reflect that slightly better than expected tone that is normal during earnings season.
Hey, meantime, Gina, you guys are out with some research, you and your team, and you say the scorecard still looks outside U.S. for better deals. So, we talk about the U.S. being the cleanest dirty shirt, and yet opportunities are really outside the U.S.?
Yeah, I think this is really interesting because in the case of earnings, the U.S. is not the cleanest dirty shirt. It's actually the dirtiest shirt in the laundry pile next to China. So when you look at the earnings
Do you have
trends,
teenagers? No, I'm just kidding.
I do not, though, nearly. So I can relate somewhat. But when you look at the earnings trends, you don't get the support for stocks. I think that the equity market has largely benefited from a flight to quality story that has really played out in currencies, because when you exclude the currency impact of equities, you get a very different perspective on performance. And when you look beneath that headline, you look at the traditional drivers of equity performance, like profitability, like earnings trends, like relative valuations. Not a single one of them supports a call to move into the U.S. As a matter of fact, all of those indicators would suggest looking for opportunities emerging outside of the U.S. at this stage.
Critty, what have we seen from some of the strategists on Wall Street? Have they said, believe in this little mini rally, or it's just a head fake?
What depends on who you ask. If you're asking Mike Wilson, the perma-bear of Morgan Stanley and Wall Street, even he's on board and saying that this might be actually a structural rally might be in the works. Will it be a sustainable rally is a different story. But he said the next couple of months, because the gloom and doom is so baked into the market and expectations have come down so much and have sold off so much, maybe there is a turnaround story that we're poised for. But then if you ask some of the perma bulls, they'll say, well, look at history. All of the major bear markets have bottomed in October 1962, 1987. So perhaps, especially in a midterm year, this is the beginning of a wider turnaround story. So I guess it depends on how much gloom and doom you want to believe. There's something in it for everyone.
Do you have a dartboard?
Sure.
Do you have monkeys?
Yes, exactly.
I feel like at this rate, I feel like whatever minute, hour, day, like we get a variety of opinions.
But there is a consensus here, even between the bulls and the bears, that there is at least a short-term turnaround.
All right. Well, good to know. All right, guys. Great setup for us on this Tuesday. Kriti Gupta, thank you so much. Anchor and markets correspondent at Bloomberg here in our studio. And Gina Martin-Adams, chief equity strategist at Bloomberg Intelligence on the phone from New Jersey. I keep quoting how she talks. Those earnings estimates have come down so much from June.
Yes, and maybe that's just kind of one of the last shoes to drop here as you think about, what could set up a bottom for this market.
All right. Right now, back to world and national news for you for that. Let's turn to Denise Pellegrini. Hi, Denise.
Hey there, Carolyn. We have warnings today from Senate Democrats. If the GOP dominates in the coming midterms, Ukraine's efforts to repel Russia could be hurt, according to Democrats. Virginia Senator Mark Warner.
I do fear that there is this Trump-led America alone contingent that could have greatly increased power in the House, and a Republican House next year could undermine that support.
And Warner with us there on Balanced Power with David Weston. Meantime, House GOP leader Kevin McCarthy promising Republicans will pull back on aid to Ukraine if they gain control of the House. And McCarthy tells Punchbowl News people will be sitting in a recession and not in the mood to write blank checks to Ukraine. A tight Senate race shaping up in Pennsylvania, the focus turning to Democrat John Fetterman's health. More from Bloomberg's Nathan Hager.
Republican Mehmet Oz has cut Fetterman's lead in the polls in half since August. Fetterman had built that edge since May, even though he'd been off the campaign trail, recovering from a stroke. The two candidates meet for a debate 1 week from tonight. Democrats say they think voters are more focused on policy, but they admit an uneven debate performance from Fetterman could be an issue for him. In Washington, I'm Nathan Hager, Bloomberg Radio.
All right, thank you, Nathan. And President Biden today promising that if Democrats control enough seats in Congress next year, the first bill he will send to Capitol Hill will protect abortion rights and codify Roe v. Wade. And Biden commenting in a script in a speech to the Democratic National Committee. And that event is today. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries here on Bloomberg Radio. And I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. Denise Pellegrini with World and National News. It is Tuesday. I'm Carol Massar along with Paul Sweeney of Bloomberg Surveillance and Bloomberg Markets here in our Interactive Brokers studio. A couple of stories that I feel like they go together, right, in terms of office demand.
Yeah, I mean, I think, Wall Street, we keep hearing about as we, navigate these difficult markets in 2022, that what's one of the first things that Wall Street does to cut costs? They start cutting people. And we've seen a couple of stories, but I don't know, some of the big banks that have reported over the last couple of days are talking about their headcount has in fact increased.
Which is interesting,
It's
right?
interesting. I'm not sure if they're working in the office or where they're working, but the headcount's been increasing. And I think what we've heard from a lot of these big financial institutions is for every trader they hire, it seems like they hire 2 or 3 computer programmers. I mean, all the technology investment they're making is headcount. And so, they're competing against the Microsofts of the world and the IBMs of the world. So interesting how they're still kind of growing their business.
Well, Matt Boyle of our Bloomberg News team, who covers kind of the work environment here at Bloomberg, has a story out that talks about offices in New York specifically and other big U.S. cities last week filled to their highest levels since the pandemic hit, but occupancy still hasn't surpassed 50% in most places.
Yeah, and I just don't know where that number ends up. It doesn't feel like it's going to be materially higher in the next year or two. I don't know.
I don't think so either.
I can just tell by the train traffic. I'm on the New Jersey Transit every day.
Right.
Mondays and Fridays, I'm kind of by myself with the conductor, and then Tuesday, Wednesday, and Thursday, pretty crowded.
Yeah, it feels like there's still a lot of open space. We're going to talk later on with Mark Dixon. He's the founder and CEO of IWG, and he's going to talk specifically about how he and his team have found that cost-cutting efforts by a lot of CEOs could kind of fuel the flex workspace. And I do think about that, Paul, if we're going to get into a tougher economic environment, a recession, are we there already? Might we get there later on next year? The CFOs looking to cut costs are saying, let's move to flex workspace.
There's a story out on the Bloomberg today about GE closing down its suburban New York City campus up in Westchester. It's a huge campus where they bring people together
It's
from
like
all over the world.
legendary, isn't it?
Yep, Crotonville, I believe it's called. So interesting there, they're shutting that down permanently.
It's very different. I think people do look at the need and use of workspace very differently post-pandemic. All right, you're listening and watching Bloomberg Business Week. Carol Masser along with Paul Sweeney, and this is Bloomberg Radio.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We have got the Dow, the S&P, and NASDAQ all advancing. Choppy session with the S&P up right now by 48 points, higher by 1.3%. Stocks are regaining some lost ground as investors assess prospects for earnings growth against a backdrop of rising interest rates. 10-year yield right now 4.01%. The 2-year 4.43%. The Dow up 374, up 1.2%. The S&P again up 1.3%. NASDAQ up 122, up by 1.1%. Spot gold up 0.1%, 16.51 the ounce, while West Texas Intermediate crude is down 2.8%, 83.07 a barrel on WTI. Bitcoin at 19,402. Bitcoin down by 0.7%. Walmart is starting a platform for social media influencers, a bid to get some help from online content creators to sell everything from food to apparel. Walmart shares up now by about 2%. Recapping stocks higher, S&P up 1.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Come on, Charlie. I want to get to, I think, what is my favorite story today.
We've got to stay tuned for that, but please share, which is?
Listen up, everybody. And I am just going to put it out there. This is my favorite read of the day. I read it in this morning. It's also most read on the Bloomberg.
Yep.
And Paul, it's about how the Fed is giving us all a lesson when it comes to lag time.
Yeah, absolutely. I mean, the Fed is raising rates. They're raising rates aggressively. They've communicated that clearly, but it takes time. It doesn't work immediately. And Allison Schrager joins us. She is a senior fellow at the Manhattan Institute. She's also a Bloomberg opinion columnist, joining us on Zoom from the tri-state area. Allison, a lot of folks were expecting, okay, the Fed raises rates, the economy slows. And I would argue, or it seems like, other than maybe the housing market, this takes some time here, doesn't it?
Yeah, it does, because it's an inflation. Your expectations about inflation are in the future. You agree to a rental contract, you agree to a wage increase. This all happens, a year in advance. So that's one of the reasons it takes a long time for Fed policy to work.
What's important, and I have to just put out there, you are the author of a book with a great title, An Economist Walks into a Brothel, which my daughter swiped off my bookshelf, who is studying economics, so she swiped it. You talk about the importance of expectations. We often talk about that in the financial markets overall, but when it comes to inflation, inflationary expectations, it's measured, we follow it. Why is that so important?
Well, as I just said, when you agree to a wage contract, you agree to rent an apartment, whatever, this is based on what you think inflation is going to be over the next year. So, the monetary policy has shifted a lot in the last 30 years of thinking expectations, or how you can influence people's expectations, is what really matters and is the most powerful tool for monetary policy. So it's super important.
Well, and just to follow, there's a difference between those expectations being well anchored and unanchored. What's the important distinction there?
Well, if they're well anchored, then people have put a lot of credibility in the Fed. This is one of the reasons why for a long time the Fed was targeting 2% inflation. It was this idea as, we'll say it's 2%, everyone will believe it's going to be 2%, and everyone's going to conduct the economy as if it's going to be 2%, and it becomes a self-fulfilling prophecy. But that all requires that people actually believe the Fed is actually going to deliver 2% inflation, and it seems like they've become unanchored now.
And Allison, a lot of folks are saying this is not your grandmother or grandfather's inflation. A lot of this was kind of due to the supply side issues resulting from the pandemic. And maybe there's a limit to what the Fed can do. And that's probably a valid argument, I would think.
It is. I mean, unfortunately, this inflation has many fathers. So, the supply side issues definitely, were part of it. But we also, partially we were following an old playbook in 2020 and 2021, which is to boost the economy, you've got to boost demand. So we had this severe contraction in supply and then boosted demand on top of it. So all around, you just got a lot of inflation. And, even if you do have supply-induced inflation, the remedy is often to reduce demand, because that's really sort of a lot easier to control. The government can do things about supply, but it's even longer lags. As I said, if Fed policy takes a year, maybe more, government sort of boosting supply can take, other than sort of certain trade policies, can take even more time, like 5-10 years.
So one of the things I also loved in your story is you said the bond market has a terrible track record predicting inflation. If history is any guide, bond traders are the last to know when inflation is about to change, which I feel like, Allison, we spend a lot of time when we're talking with our TV colleagues about the financial markets. Oh, watch the bond market. It knows what it's doing. You're saying not necessarily the case.
I've never understood why that's a thing. I mean, it's that they have a terrible track record of predicting inflation. I don't even really believe inverted yield curves tell us that much. I mean, it's that these, you know, they're just, bond traders are human and they're just as fallible as the rest of us, and they don't have special insight. And in fact, I think considering bonds are such long-term assets, they tend to be very short-term in their thinking.
You know, Allison, this Federal Reserve has been really clear, I think, on its messaging here. I mean, starting with Jackson Hole, you know, if you weren't paying attention that we want to fight inflation, now you better. And they've been very consistent. Is that part of being a good Federal Reserve, is clearly communicating to the market really where you want to go?
It is. I mean, I think it's following this intellectual tradition, that this idea that, you know, communication and setting expectations is the most powerful tool. I think the problem the Fed has is it's a little late. Like, if they were more ahead of the curve on inflation, they might have had a bit more credibility. But the fact they kept insisting it was transitory, they keep putting out forecasts that suggest inflation is going to be back to like normal in a year, I think really undermines their message. So I think they're now doing the right thing, but it's a little late.
All right. So when someone like a Mark Mobius says, hey, guys, get ready for maybe 9% moves in interest rates because that's what it's going to take to bring down the current inflation, how do you think about how high the Fed might need to go and how much we need to kind of get our heads around it?
I think 9% is a little high. I agree it would bring down inflation, but in that case, the cure might be worse than the disease. I think, you know, they're definitely going to go above 5%. The inflation number, I mean, the way I think about it is you want sort of the real interest rate to at least be at inflation. So the Fed is still not sort of trying to pump demand. But I would look at core inflation rather than overall inflation, which is inflation minus food and energy. So that's what, about like 6.9% around now. So, I mean, and it might go down just as more supply chain issues ease. So probably, I think 9% is a little high, but we could be looking at 5.5%, maybe 6%.
All right, good stuff, Allison. Really appreciate it. Allison Schrager, Senior Fellow at the Manhattan Institute. She's also a Bloomberg Opinion columnist joining us on Zoom, which we appreciate. We get to see her. So that's she's zooming into us from the tri-state area. So good stuff here. It's inflation. It's the Federal Reserve. The Federal Reserve, yes, if you listen to most experts, was behind the curve, maybe still behind the curve, but it's not for lack of trying, at least over the last 6 to 9 months.
But, you know, we keep saying, okay, we're looking for signs for it to come down, but man, is it sticky in terms of coming down. But she did emphasize, you know, focus on the core, which is something we talk about a lot. Check out her book, too. It's a great title. It's a great book. An economist walks into a brothel and other unexpected places to understand risk. All right, you are listening and watching Bloomberg Business Week on Bloomberg Radio, on YouTube. Hey, coming up, we're going to talk about the latest big bank to report. We're talking about Goldman. Stock moving on the news. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So thank God for trading.
Yes, exactly. Especially fixed income trading.
Right?
Yes. Every quarter it seems to be different. The bankers lead the day, then some quarters it's the capital markets. You know, it's...
Yeah, but for Goldman, it was about the traders.
Yep.
And the stock is rallying big time. We're going to get into their latest update and an outlook with our person on the job, Allison Williams of our Bloomberg Intelligence team. First up, though, let's get back to the markets and Charlie Pellet.
Thank you very much. A lot of investors hoping to bank on further gains with the Dow, the S&P, and NASDAQ all advancing right now. 50-point jump for the S&P, up by 1.4% right now. Right to the numbers, we'll give you a why in a moment here, with the Dow up 400 points now, up 1.3%. We've got NASDAQ up 125 points, up 1.2%. The NASDAQ 100 index today now rallying by just about 1.1%. The 10-year 4.00%. We have got the 2-year yielding 4.43%. Gold up $1 at the ounce, $16.51. Little change there. West Texas Intermediate crude down 2.9%, $83.02 a barrel. Bottom line here, stocks are continuing their rebound from nearly oversold levels as traders assess prospects for earnings growth against a backdrop of rising interest rates. Among some of the companies out with earnings this morning, we did hear from Goldman Sachs, now up by 2.7%. Also higher, little change, Johnson & Johnson up by 10 cents now, up by less than 0.1%. So investors are digesting the latest batch of earnings reports. Netflix, United, J.B. Hunt among the names scheduled to report after the close of trading. Kate Moore is head of thematic strategy at BlackRock Financial Management.
Companies have a lot of levers to pull and use in order to engineer better earnings. And I would expect if revenue growth meaningfully weakens and the inflationary pressures across a whole variety of goods and services don't ease, companies will do things like reduce headcount, slow down investment in different parts of their businesses that are not as profitable, all to protect the E. So you can have a weaker economic environment and actually a solid earnings environment.
And right now we've got Netflix dropping by 0.8%. This on a day when stocks are higher. UAL up 2.6%. JB Hunt up by 1.4%. Netflix, UAL, JB all reporting after the close of trading. Again, recapping S&P up 48, up 1.3%. Goldman now up 2.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
She's an incredible analyst, and she's also a comic.
And she's running around doing the research analyst stuff, doing TV, doing radio, because some bankers reported earnings this morning, I think.
Something called a little company named Goldman Sachs. Stock's up almost 3% in today's trade. Let's get to it with Bloomberg Intelligence Senior Global Banks Analyst Allison Williams. She's here in our Interactive Brokers studio. All right, walk us through, what do we need to know about Goldman?
So number one, trading still is the majority of their business, and they delivered on trading. So fixed income trading up 41%. That led across that, and fixed income trading was the highlight of the investment bank this quarter.
Yeah.
For all banks, it was net interest income, but looking at the investment bank, fixed income highlight, fees the low light.
So how about on the equities business? Because we got an S&P down big this year, NASDAQ down big. Can you make money trading equities in that kind of tape?
I think the activity is helpful, but we're up against a really strong quarter from a year ago. Okay. Prime brokerage is a business that benefits from higher asset prices, use of leverage. So as you can imagine, that's not doing as well. But I would say for Goldman, the focus is, what's happening on the market share front. They are one of the top three with Morgan Stanley and JP Morgan, and that race has gotten a little tighter in recent quarters. I mean, in a way, that's all about bragging rights because they're all, as the top three, focused on profitability and doing well. But, Goldman held its own there. And then to the fees, everyone's fees are down dramatically. I mean, broad declines across equity underwriting, debt underwriting, M&A. So pull all the numbers.
I know.
70 to 80% for your old friends that are working away and trying to do deals, and unfortunately not getting.
They had a few record really good years.
I mean, last year was truly amazing. I think we were at a record, in the middle of the year.
Yeah.
So this is when, Allison, when it's these bad markets, I talk about the pipeline. How's the pipeline at Goldman Sachs? Look, like if I would have much to talk to my bosses about, I say, but I got a great pipeline.
Right. And you would be saying that, and you would be saying the same thing since January. The pipeline is strong, and that is the positive things, that we haven't seen that sort of take a step back. But the question is, when will that get executed? We have a few more days like we've had the past couple of days. If we can get a little bit more rally, does that open up a window to get some of these deals done? I think
Kroger and Albertsons did a deal. Like, there are things happening.
There are, and it was interesting. If you looked at the debt side of things in August, things opened up, and it was a really strong month on that side of the business. There's a lot of questions around the leveraged loan marks, right? There were a lot of marks last quarter. This quarter, where are the marks?
And you know what? We're also seeing the endowments are starting to report their performance, and they're actually I thought it'd be down 20%. This is through June. They're kind of flattish. Wow. And what that tells me is, A, they were pretty well hedged, but B, they haven't marked their big private equity investments to date. I wonder if the banks are slow to mark investments, because these things got to be down significantly.
Well, there were big marks in the context, right? So there were marks last quarter. I think this quarter was less because I think when the window opened up, maybe there were some things that got done. A couple banks did give a number. Citi gave a number. I think it was something like 100 million. Last quarter was 126 million. Deutsche Bank and Credit Suisse are going to be the ones we're watching because they're bigger in the leverage business. Deutsche Bank has said they expect something. We'll find out how big that is. But I mean, for the industry, Jamie Dimon, I think, made the great comment. It's a fifth of what we were at the financial crisis. So you remember back in those days, that was a real concern, what was going on. And just because of the size of that business and the size of banks' balance sheets today, smaller business, bigger balance sheets.
So is there some, Allison, net takeaway as we try to kind of glean from what the CEOs had to say and how the big banks performed, what it says about the outlook here?
I would say the three takeaways. One is the net interest income, which was super strong. That, third quarter fees at least are steadying quarter to quarter, so still down a lot year over year, but we're starting to see some steadying, so that bodes well for next year. The last thing, provisions. That's what we called the wild card coming into this quarter.
Right.
And they were a little bit higher than we expected, but not by much. So I would say tweaking the credit view, and maybe the biggest number that we got, or the biggest statement for the quarter, was Jamie Dimon saying, if we go to 5 to 6% unemployment, 5 to 6 billion in provisions, that's obviously worse than people expect, but nowhere near what we saw pandemic.
Okay, good to know some perspective.
As always.
Yeah. Bloomberg Intelligence Senior Global Banks Analyst Allison Williams, thank you so much. Really appreciate it.
All right, let's get a check on the latest world and national news with Denise Pellegrini in our 1130 Bloomberg Newsroom in New York.
Hey there, Paul. And another sign of positivity for the economy. Many of those banks you were just talking about, well, they are also increasing headcount, especially Goldman and Wells Fargo, the only one that has cut headcount lately. House Republican leader Kevin McCarthy says if the GOP takes back the House in November, Republicans will cut back military support for Ukraine. But Virginia Democratic Senator Mark Warner says that would be dangerous. He says Russia, meantime, getting drones from Iran speaks to Moscow's military desperation.
It's a telling comment that the Russians have used up so much of their munitions that they're actually turning to Iran and North Korea to buy additional armaments.
And Warner with us there on Balanced Power with David Weston. Republicans also have some other things on their to-do list if they dominate on Capitol Hill next year. Bloomberg's Amy Morse has more on that.
Republicans have vowed to investigate several Biden administration actions. Representative Michael McCaul of Texas has zeroed in on the Afghanistan withdrawal. He wants the State Department to preserve any relevant documents that, quote, may be potentially responsive to a future congressional inquiry, request, investigation, or subpoena. In a report released in August, McCaul called the withdrawal a strategic failure by the Biden administration. In Washington, I'm Amy Morris, Bloomberg Radio.
Thank you, Amy. And members of the French industrial company Lafarge pleading guilty to charges of conspiracy to provide material support to foreign terrorist organizations like ISIS. U.S. Attorney Breon Peace.
In 2013 and 2014, Lafarge made a deal with the devil.
Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini. This is Bloomberg.
All right, you are listening and watching Bloomberg Business Week on this Tuesday. Carol Massar along with Paul Sweeney. And, I was thinking it's been a while since we had a story about Twitter.
Exactly.
And bring
Yep,
comes.
there you go. I mean, is Elon Musk, I believe the date is October 28th, where the deal has to close if it's going to go through. And as you know, Carol, in Silicon Valley, it is a very, kind of stock and options rich economy out there. That's how the people get paid out there. So Twitter locks staff stock accounts in anticipation of deals. So I guess Twitter's getting ready, saying we're going to shut down your accounts for that you can maybe buy and sell stock in the options, which are very active. And it's a big source of just daily income, annual income for these people, but they're locking it down in anticipation of this deal closing.
I love this that it happened on the employee FAQ page.
Yes.
So like if you randomly are going to the FAQ page, you found this out essentially.
Yeah.
They alerted staff that they won't be able to access or trade shares from the Equity Awards Center. Page said the change was done, quote, in anticipation of the closing of the pending acquisition of Twitter by an entity controlled by Elon Musk, according to two people familiar with this charge, are Kurt Wagner and Ed Ludlow reporting.
Yeah, great reporting as always out there. But I wasn't aware until I got out to Silicon Valley years and years ago. They kind of treat their stocks and their options and the liquidity associated with them, which is limited, but it's much better than it used to be, as to pay the bills.
Right.
If I've got a tuition bill coming or a house payment, I go to my firm and I sell some of my options or some of my stock, and it's just such a big part of their daily financials. Different here than.
So this is normal that we're hearing this.
Yes, I think so. But I think it would have been via some nice memo saying, "Hey guys, good news, we're about to close this deal, and if you own stock, you're gonna get $54.20. But just to comply with certain regulations, you can't trade in your account until we close."
Interesting too. And if anybody was wondering, so Twitter seems to think this is going to go through, and certainly any legal expert you say or talk to would say that this is contractually that Elon has to go through with it. Twitter shares a little bit higher on the news. You are listening and watching Bloomberg Radio.
Connection lost.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We're looking at a late-day fade here. Still green on the screen, but NASDAQ now up by 7 points, up less than 0.1%. The S&P holding on to a 17-point gain, up by 0.5%. The Dow up 196, up now by about 0.7%. Key takeaway, well off session highs. Traders are assessing prospects for earnings growth against a backdrop of rising interest rates. Speaking of earnings, as we were talking about, we heard from Goldman Sachs this morning. Goldman up now by 2%. Also heard from Johnson & Johnson down by 0.1%. Netflix among the most closely watched coming up after the close of trading today. Netflix down now by 2.1%. Hasbro, the maker of Transformers toys and Peppa Pig Entertainment, reported earnings that missed estimates despite providing a business update just a couple of weeks ago as consumers curtail toy spending amid sky-high inflation. Hasbro down now by 2.4%. 10-year yield 4.00%. Spot gold little change now, $16.49 the ounce. West Texas Intermediate crude down 3.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. So we know earnings season is getting into full swing, and next week we'll get an update on the business of Meta Platforms. And ahead of that, in a story you can find online at BloombergBusinessWeek.com, how the founder of Meta, of course we're talking about Mark Zuckerberg, isn't saying much about the core platform in business known as Facebook.
Exactly, right.
We're also going to get the truth behind the legs on the avatars in the metaverse. Let's get to this story. It's by columnist Max Jafkin, who joins us along with the editor of Bloomberg Business Week, editor Joel Weber, both in our studio. But Max, let's kick it off with you. Tell us about what is really the focus. We know it's all about the metaverse for Mark Zuckerberg right now.
Right. So Meta, aka Facebook, is a very interesting company right now because on one hand you have this enormous and very successful, dominant business, which is social networking and advertising. So dominant that governments all around the world are worried about regulating it, even possibly breaking it up. We saw they'd have to divest from Giphy, a tiny company they acquired a couple years back. And then you have the metaverse, which Zuckerberg is very excited about, talking about all the time, and is seems to be the much of his focus and the focus of the sort of senior executives around him. And there really just isn't a whole lot of traction, despite tons and tons of spending, and almost mind-boggling sums of money that they're spending to try to make this thing happen.
Is there traction within Facebook for the metaverse?
Well, that is what's super
details.
Super discouraging from the point of view of a sort of Meta investor. We saw reports over the last couple of weeks of Meta employees not wanting to use their own product, which again, that's sort of discouraging on one level because you'd expect and hope that the people who are building this thing are excited about it, but also because Zuckerberg is pushing the idea that the metaverse is going to make a huge difference for office work, right? That it's not just a video game platform, and the reason he's doing that is because the video game business is actually pretty mature. They've been at this for almost a decade, and the fact that they can't get their own employees to use the platform how they say we're all going to use it in the future, doesn't bode well.
Hi, Max. So I wanted to
Are you
ask
in Horizon Worlds? Is that what happened? Did we lose him?
Well, I was there for a second, lost in a spreadsheet on my phone, and as you write, soon going to be strapped to my face, that spreadsheet, so I can see it much more closely, I guess.
The metaverse comes into clarity.
But I do think there's an interesting kind of strategic decision here at Meta of this tack maybe away from consumers and toward the corporate world, and walk us through how that's looking so far.
Right, so if you watched Connect, which is their annual developer event for VR, a lot of the focus was around office work, as you said. And, the big special guests, they had some gaming announcements and they did sort of the usual stuff. But the big get was Satya Nadella, the CEO of Microsoft, talking about now you can, load Microsoft 365, which is the product most people know as Office, Word, Excel, PowerPoint, you can do that in the metaverse. The chief executive of Accenture showed up to say, we at Accenture, think this is such a great thing. We've been, doing brainstorming sessions on the nth floor, which is the consultancy's, metaverse thing. And again, this stuff potentially could matter, and you can sort of understand from a strategic perspective why Microsoft or why Accenture thinks this is a good idea. Microsoft wants to be everywhere, but
PowerPoint's in the metaverse. Yeah, I'm there.
So hey, why not? On the other hand, it's really hard to watch that and think like, who is going to get excited about this? They're talking about sort of the parts of office work that everyone hates, spreadsheets, management consultants, brainstorming, sessions or whatever.
Floor, where is that again?
You really have to, you'd have to be like sort of be a management consultant to like this, which again, okay, maybe there are a lot of management consultants. Maybe that could be a good business, but it just doesn't feel like they're generating a ton of excitement. And when you compare that to the revenue, the amount of spending they've done, we're talking something like $27 billion since early 2019, and they call that an investment. Of course, Wall Street calls it a loss. So we'll see.
Okay, so the headset is another thing that comes up in the story and has been talked about a lot. It's expensive, $1,500, right? Like what's your take on the headset?
So the headset, it'll be very interesting. Apple is widely rumored. We've reported that they're working on a headset. It'll be interesting what they do. I think the headset was both sort of more expensive than a lot of people who watch the space closely were hoping. $1,500 is 3 times what Facebook's sort of consumer headset costs. It's kind of hard to imagine somebody upgrading. And then the technical capabilities, it includes eye tracking, which is very cool, I guess, the company says, for sort of meetings and things like that. But battery life is lower than their cheaper headset. The processing power doesn't seem like hugely better. We even had a Meta employee, John Carmack, who's like a industry pioneer, sort of saying, there are pros and cons to this device, which you wouldn't really want to hear when you're talking about your hot new product that you just released compared to something that you released, 2 years ago that costs a third the price.
I'm wondering if nothing else, this metaverse discussion has taken some of the attention away from some of the problems that Facebook has with the regulators, elections coming up, things like this. It kind of feels like at least maybe an unintentional head fake.
So, or maybe it's an intentional head fake. I mean, one of the interesting things that's happened is you go back 2 years ago, we were heading into a general election, and all Mark Zuckerberg wanted to talk about was the platform's sort of responsibility to society. Right. We saw, Meta talking a lot about, back then called Facebook, talking a lot about election integrity, also talking a lot about public health and things like that. Now, what's happened since then is some of those duties have been sort of pushed off to other parts of the company. We have Nick Clegg has been elevated to this sort of role that Zuckerberg, I think, himself was largely handling before, and as a result, all the focus in terms of media attention and from a public policy point of view is on this new thing, which I think has come with some pros and cons. On one hand, Zuckerberg isn't taking it from all sides, like is not maybe being criticized as much, even as there's tons and tons of misinformation on the platform today. On the other hand, a lot of focus on this platform that really doesn't seem to be thriving.
And breaking up of those election teams that were sort of a response to sort of some of the sketchy stuff that had happened previously, and as you write, your kicker, pretty memorable. Got to pay for that metaverse somehow.
Well, and Zuckerberg went on Joe Rogan's podcast a few months ago to talk about the metaverse, and that huge opportunity for the metaverse. But Rogan has been like a prominent vaccine skeptic. He's somebody who is kind of playing in this disinformation ecosystem. He's like exactly the guy that Mark Zuckerberg 2 years ago would have avoided. Right. And now we see Zuckerberg kind of pivoting away from those concerns and to pumping this metaverse. With questionable success.
Well, it's an incredible read, and if you want to find the truth about the legs on the avatar, you're going to have to read the story on the terminal or at Bloomberg.com. Another great story from Max Chafkin, columnist at Bloomberg Business Week, and our thanks to editor Joel Weber, editor at Bloomberg Business Week, joining both in our studio. You are listening and watching Bloomberg Radio.
Down to the Close, Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Massa, Paul Sweeney, Tim Stanovic. We together welcome fully across our audiences of TV, radio, YouTube. A moment where Paul, who's in for Tim, of course, and the perfect voice, because it is Apple that kind of dictates trade for the last few minutes. We suddenly see a drawback in that particular king stock and maybe a pullback in some of the benchmarks. But overall, Carol, we are still driving higher.
Yeah, absolutely, right? We did see a little bit of a fade, but we're bouncing off those lows again. Watching, for me, the airlines, we do have United reporting after the closing bell, and they have, in general, been outperforming in today's trade. If I look at the S&P Airline Index, it's up almost 2% as we speak. That group, by the way, up about 10 to 11% since a low in late September. United also rallying ahead of its earnings. That stock alone, Paul, is up about 16% since that September 26th low.
Yeah, absolutely. Another name going to be coming after the close, highly anticipated, will be Netflix. The stock's off about 1.5% today, but the off down at about 60% year to date. So there's a lot of concern here for Netflix in terms of their new subscriber ads and as well as their advertising supported tier that they're just about to launch.
At the moment, it feels like the micro is kind of usurping the macro concerns right now. Let's dive in, though, to the macro benchmarks. We are up 0.6%, 2/3%, let's call it, on the S&P 500. And we're actually seeing volumes tick higher a little bit on the day. We've got the Dow Jones up 0.7%. Lagging is the NASDAQ, now up only 0.3%. We thank Apple's pullback for that in large part, but still volumes actually up about 20% versus your average. The Russell 2000 still holding on to gains of 0.6%, Taylor.
And you wouldn't know it by looking underneath the surface, but it's actually a broad-based rally. Every sector is still in the green. Technology, though, is the laggard, and that what gives us sort of a hint of being less bullish than we were yesterday. Technology sector, of course, unched to maybe 0.1% higher on the day, but otherwise remains pretty risk on. If you think about the cyclicals, industrials, materials, utilities, those are higher.
But a lot of single name volatility out there. You mentioned it at the top, of course, with Apple back in the red right now, down 0.3%, was higher by more than 3% here on the day. All told, it's actually a swing from peak to trough of more than 4% here. So we'll keep an eye on that space. Similar story with Netflix. We get those earnings after the bell. The shares actually opened higher by about 2% on the day, and then we're down as much as 3% here. Now down right now 1.8% here. So again, a lot of volatility around two of the biggest names out there in the S&P and in the NASDAQ. Meanwhile, two interesting activist stories going on right now with Colgate-Palmolive and Dan Loeb and Third Point taking a stake in that company and agitating for change, including the potential sale or spinoff of that pets business. Colgate-Palmolive shares up about 1% here on the day. And Salesforce, we were just checking in with Anurag Rana over at Bloomberg Intelligence, talking about Starboard and it taking a stake in Salesforce. Anurag seems to think that this actually is a good idea, maybe a little bit more cost discipline over there for Salesforce and its leader. 4% gain here on the shares on the day.
Well, what about Dreamforce? Meanwhile, let's have a look at what's happening in terms of technical.
What'd you call it? You said it's just one big
music
concert?
festival.
Music festival.
Lenny Kravitz was there this year.
Was he? Lenny?
Yeah.
Wow.
He doesn't come.
That's where he is? She's just hanging out at Salesforce?
All the celebs are. Let's have a look at what's happening in terms of your technicals, though, because actually maybe in large part that's what's been dictating trade too, this desire to be getting on these valuations and the technical levels. 200-week moving average is, of course, what we broke through on Friday and we pushed back above on Monday. We sustain it today. The 50% retracement level as well. We are north of that, about 3,500. We're currently, of course, at about 37.
One of my favorite memes was that when he was wearing that gigantic scarf, Lenny Kravitz was walking down the street, and then everyone kept editing the photo to the scarf got bigger and bigger and bigger. Good times. You got something, Carol?
I certainly do. I'm just waiting for you to finish up. All right, I'm going to go back to what Caroline was saying because she talked about the S&P and support levels, and they've definitely been helped out by the big banks, which are up about 7% since JP Morgan first reported last Thursday. Goldman reported today, so that stock move higher. We love the commentary that we get from the big bank CEOs, and that includes our Sonali Basak, who caught up with the CEO of Goldman Sachs. We're talking about David Solomon post-earnings, and here's what he had to say. When you tighten economic conditions so quickly, and we are really are tightening them very, very quickly, you're going to have, disruption in economic activity. But he pointed to so many different concerns, guys, throughout that conversation he had with Sonali. He talked about rising rates globally, equity markets well off their highs, geopolitical instability, GDP growth expectations are declining. I mean, Paul, that worry list is pretty long.
It is. One of the industries I really like, I think it's a very interesting industry, but I've never been on a cruise, but I love the cruise industry. But Carnival's up about 11% today. They were able to get a bond deal done today. The bad news is they had to pay 11% coupon, much higher than what we've seen from like issuers. But the good news is they were able to upsize that deal from $1.25 billion.
Paul. That actually seemed like a good deal, given that everyone thought they should probably be paying a lot more than that.
Yeah, the price talk came in a little bit better. The demand came in a little bit better.
And the stock is up 11%. It's the number one gainer in the S&P 500 today, even if you take a look at that balance sheet and all that debt. Pretty impressive.
It was interesting, too, going into some of those segments, Paul. We were talking to Olivia Ramonde about how the average yield right now on the high yield index on a yield to worst basis is about 9.6, 10%. So 11% doesn't seem that bad. I think when we think about this stability that we're getting, is this an idiosyncratic story about investors just sort of are gravitated to this name? Or is this a little bit of a signal of a little bit of a reopening of those credit markets, a little bit more of a willingness of investors to take on some of that risk? That narrative seems to prevail when you're looking at day two of what has been a decent rally here.
Oh, HYG, the ETF that tracks high yield, currently up for a second straight day. It was at 1.25% yesterday. It's up another 0.5%. So maybe just once again a signal of a little bit of the moon music changing and people wanting to put a little bit more cash to work at these levels, not calling a bottom. The Bank of America survey saying, look, it's really going to be into mid-2023 when really the true capitulation moment comes from the Federal Reserve, but maybe just willing to put some money to work at these levels.
And that kind of has to circle us back to earnings here, and the idea that the companies aren't basically talking about us going off in the cliff. I mean, we mentioned the David Solomon quotes, and of course we heard from Brian Moynihan of Bank of America, as well as Jamie Dimon, and now I guess tonight maybe we'll get some commentary out of Netflix, Paul. I know they don't have a traditional conference call in that, people actually ask them questions and they respond. It's just one person, but it'll be interesting to see what they have to say about just demand going forward.
Yeah, absolutely. And of course, next week, we get a lot of the big tech names coming out next week, and that's always a big market-moving event here to get a sense of where capital spending is for the global economy as it relates to technology. So we'll find the winners and losers next week.
And it'll be interesting to see if even, a little bit of a beat, a little bit of an outperformance to that lowered bar, whether or not investors react positively or whether they're looking for a lot more in those releases.
Meanwhile, the meme from Lenny Kravitz was brought about in the year 2012. Romain,
wow, is that long ago? Wow.
I have to say, go online and Google Lenny Kravitz, and it's the fourth thing that comes up is Lenny Kravitz scarf.
I mean, it was a nice scarf. It was just a little large. That's all.
He was cold, apparently, Romain. He's cold, and he still owns it.
He still owns it?
Yes.
Okay. Can we get an interview
Everybody's
with that
going to be Googling that meme right now. We know that's what's going to happen. All right, guys, we're going to be...
Scarf indicator. That's capitulation.
It could happen. It could happen.
Breaks that scarf out again.
All right, we're going to be back in less than an hour's time. Our cross-platform coverage, radio, TV, YouTube. We're going to count you down to the close. Beyond the bell, we're going to count you down to the close on this Tuesday.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you're listening and watching Bloomberg Business Week. We're going to get back to our TV colleagues and count you down in less than an hour's time. In the meantime, I mean, that Carnival issue, it's a big deal.
It is. I mean, it's interesting. Carnival issued a lot of debt here today. They have a very tough balance sheet in a tough operating environment, but they're able to upsize the deal. That's a good side. And the coupon actually came in a little bit lower than the price talk. The price talk this morning was about 11.5%. They were able to get it done at 11%. So, maybe just a little bit of an opening for some of this new issuance here in the credit markets. We'll see. But they've got to earn their way out of this balance sheet over the next couple of years.
I do think it's interesting, though, what it says more broadly about the market, that there are investors willing to take it on, right? You do wonder if there was financial stress or tightening within the financial market conditions.
Very loyal people. They love to cruise. They're like, pandemic? What pandemic? Let's go.
Have you talked to Charlie Pellet?
Yes. Oh, yes.
I did a whole thing on Carnival a few years ago, and I remember being on the ship and being in an elevator and talking to people, and they're like, oh, yeah, this is my fourth cruise, or this is my fifth cruise, or I'm already thinking about coming back. So you're absolutely right. They are incredibly loyal.
And they are investing in their ships, and they're ready for growth as an industry.
Yep, and had been getting rid of some of the older ships that they've got, just like the airlines, right? They get rid of kind of the less efficient,
Have you been on a cruise?
No. I only did it because I went on a cruise because I was doing a report, so I did a kind of double night overnight to kind of do some reporting and filming.
Okay. All right. I'm thinking about it.
I would like the smaller cruises. I'm a
Yes,
smaller boat
maybe a
kind of
river
person.
cruise in Europe.
Yeah, a little Viking. I think they,
Yeah,
and
it's
they
like-
own Viking.
Yeah, that's right.
They own a lot of brands. All right, let's get back to world and national news. For that, it's back to Denise Pellegrini. She's in our Bloomberg newsroom. Hey, Denise.
Hey, Carolyn. President Biden hoping to cruise along with U.S. voters, saying if Democrats keep control of Congress in November, he will send lawmakers a bill protecting a woman's right to abortion.
In just 4 months, abortion bans have gone into effect in 16 states. 26.5 million women of reproductive age already live in states subject to these bans.
And Biden speaking there at a gathering hosted by the DNC. Many tight races as we head toward the midterms. A lot of candidates in all-out sprints. Trump-backed Republican Senate candidate Dr. Oz appearing at an event near Jonestown, Pennsylvania, with voters like Joe Antel unsure about Oz.
Might be a nice man, but I don't like someone coming from another state, New Jersey, coming in to run for office. I really feel that is his number one drawback.
Just to be clear, nothing wrong with being from New Jersey, just that he's from another state there. And a new Trafalgar poll shows a tightening race with Oz and Democrat John Fetterman in a statistical dead heat. And could Washington be encouraging repressive regimes overseas with its revolving door policy? Bloomberg's Nathan Hager says the answer could be yes.
An investigation by the Washington Post finds more than 500 retired top brass have taken jobs with foreign governments since 2015. For instance, Saudi Arabia has paid 15 retired generals and admirals to consult with its defense ministry. Other retired officers have gone on to work for the United Arab Emirates and other Gulf states. Congress allows retired troops to work for foreign governments with permission from their branch and the State Department, but the U.S. government does work to keep those hirings secret. In Washington, I'm Nathan Hager, Bloomberg Radio.
Thank you, Nathan. And global news, 24 hours a day on air on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. Just a correction, Carnival does not own Viking. It's owned by a Norwegian billionaire businessman, Torsten Hagen. Their high-end premium brand is Seabourn.
Yes.
Which is that kind
Gotcha,
of
okay.
idea. So
Yeah.
I just wanted to make sure I didn't mess up my cruises there. In the meantime, kind of a related story. This in our own home state of New Jersey.
Absolutely. I love this lead here. A more than century-old swing bridge in New Jersey that sometimes needs to be sledgehammered to be closed is a step closer to getting a much-needed makeover. The New Jersey Economic Development Authority, they're going to issue $600 million in bonds to help fund pay for this bridge, which is called the Portal North Bridge. I ride on it twice a day.
You do, right?
Every day.
Train, the
yes,
train?
the choo-choo. And I'm going to buy some of these bonds myself. I mean, you know, it's like Warren Buffett says, invest in what you know. Well, I know train tracks and the New Jersey Transit.
You know, and they're well traveled, right? This is
my
the
God, a
this
gajillion
is
people. Yeah.
it is the busiest train bridge in the Western Hemisphere. Was called a choke point, a bottleneck, an Achilles heel on the Northeast corridor, by President Joe Biden last year. We know in and around some of the infrastructure in the New York Metro is so old and so needs help.
Yeah, this is all part of, I believe, the Greater Gateway project, which is basically to get a couple more tunnels going into Manhattan from New Jersey. And it's not just for New Jersey Transit, it's for Amtrak, which, you know, takes you from that, that Washington all the way through to Boston. It's such a busy rail line. It's
crazy.
They got to go through these tunnels, and these tunnels are more than 100 years old. The bridges are more than 100 years old.
Yep.
You think it's time to upgrade a little bit?
Yeah.
So we've been talking about this for my 35 years of commuting, we've been talking about this, and it looks like maybe they're getting something done here.
And it just gets denser and denser. There's like waterfront across from New York, Manhattan, on the Jersey side. That
I love those properties, but how do you get to them?
Yeah,
I mean, I don't know. Don't you have to negotiate the helix every time you want to go to your apartment?
It's a little crazy. Hey, by the way, the total cost of this project here in New Jersey estimated at approximately $2.4 billion, of which roughly almost $600 million will be funded by that bond sale. So we're talking serious money, but man, it's time to upgrade the infrastructure in a big way. I'm just putting my 2 cents in there. All right, this is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks are higher, NASDAQ up barely. This update brought to you by SCI, with an operating platform designed to support all major asset classes, diverse strategies, and investment vehicles. SCI is redefining wealth management. Learn more at scic.com/tech. Now, let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
Thanks. And leaders to the upside in the Dow, Salesforce, American Express, and Goldman Sachs, while Intel fell 3% and led to the downside. After earnings, State Street was little change. Lockheed Martin rose 8.9%, and Goldman Sachs gained 2%. In other news, McDonald's to sell Krispy Kreme donuts at some locations, and Apple fell intraday on a report of iPhone 14 Plus production cuts. Wrapping things up, Netflix reports after the bell. Live from the First Word breaking news desk, I'm Bill Maloney. Charlie?
Thank you, Bill. To hear live breaking news over your Bloomberg, type Squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, our next guest is an entrepreneur, maybe even a serial entrepreneur. Among the companies he's founded, Thumbplay, a mobile entertainment service. It grew to more than $100 million in revenue in less than 3 years before he exited the company, which was later acquired by Clear Channel and is now called iHeartRadio. We've got a great guest with us. Ari Trusdal, founder and CEO at the data sharing platform Crisp. They have an interesting mission of helping companies make their supply chains more efficient, reduce waste, and boost profits. So he is here in our interactive Bloomberg studio. So I read about your company, Paul read about your company. Tell us exactly what you are doing and who you're working with.
Great. Yeah, so we work with a lot of large retailers, a lot of distributors, and a lot of large brands. So with the pandemic...
Brands that we know, publicly held companies?
Yeah, large brands, 400 large brands on the platform. And they saw during the pandemic and the supply chain challenges that they needed just to collaborate better with the retailers and understand the data better so that they don't run out of products. We all see empty shelves, and we've seen challenges with undersupply and overstock and all of that. And everybody realized during the pandemic and these supply chain challenges that they actually need to collaborate around data to not create waste and also put products on the shelf.
Well, and so, it's interesting that you say that. So you saw in terms of the demand for your services ramp up in a big way during the pandemic or post-pandemic.
Oh, yeah. Before, nobody cared. We were fortunate to sell a company here in New York and then traveled around the world and then saw all these challenges with supply chain, especially in the food side, where a third of all the food that's made in the world actually never reaches a consumer, 1/3. And then another 1/3 is lost when the consumer gets it. So over 50% of the food has no human, it reaches no human. So
no, it's pretty remarkable, right? In a world where people are starving, that there's so much food waste.
Exactly, over 1 billion people. So that was inspiration behind it. But before the pandemic, nobody really cared. And during the pandemic, everybody cared about it.
So, does it stay with us, Ari, like the stress that we've seen on supply chains and companies having to make them much more efficient, much more productive, much more sustainable? Is that something real, or is the sustainability aspect of it just kind of a cool thing to do, or has something changed?
It definitely changed during the pandemic. And we see all of these challenges in the supply chain. Before, it was easier to manage in a way, but now you see inflation increases, you see strikes, you see labor costs, you see shortages of labor, you see weather, you see seasons. There's a lot of things that is hitting the supply chain, and there might be 100 million companies actually collaborating in a way to get products to the consumers.
But weren't they collaborating beforehand? What's different? Because the collaboration was there. We talk about the massive global supply chain that's been in existence for decades, to be fair. So what's different?
The whole supply chain runs on technology that was created the year I was born in 1973. It's called EDI, and that's just purchase orders that get sent through. It's very reactive. And the ones that are further upstream, they actually don't understand what the consumers are doing. So they get all of these distorted demand signals throughout the supply chain. So they end up producing 1,000 when the actual consumer demand is 100. And then you get what we're seeing now, where all of this is coming in reverse in a way. So now we have overstock and oversupply, and 21% more inventory is actually sitting in the retail chains now because of this. Nike said they had 65% more inventory than they had a year ago. So now it's kind of coming in reverse again from the shortages that we had seen earlier.
Well, so how much of that, though, was companies are in many ways ordering ahead to make sure they weren't found out to be short?
You know exactly what happens. They typically say you run a retailer on the Upper East Side, you're ordering 100 products. If I'm the wholesaler and I give you 50 products, the retailer smarten up and now they order 200 so they could get 100. If I'm sending that as a retailer or my wholesaler back to a brand again, now they believe that this consumer demand has actually increased, and the brand might have 6 months to actually produce this product. So I might make 800 now, but actually consumer demand didn't change that much.
So based on, you obviously can't tell us exactly who you're working with and all the companies, although we can maybe garner some stuff from looking on the website. But what you are seeing, this supply chain story that has been with us for several years now because of the pandemic, what does it tell you about supply chains kind of getting back to quote unquote normal, and what does it tell you about the global economy?
You know, I think it's going to stay with us for a long time. I think it's going to take a long time before actually all of this gets worked out throughout the supply chain, because there's always these new disruptions that are that's hitting the supply chain. So I think it's going to stay with us for a long time.
So in other words, there's going to be shortages, and
you're going through the same things. You have too much, and then people stop.
But why is it such a mess now?
You know, there's this theory called bullwhip theory that says that it ripples through the whole supply chain and it gets distorted through the supply chain because the information is not real time. So if you're sitting 3 or 4 steps away from the actual retailer, it's very hard to understand if the consumer demand actually went up 5% or if did it actually go up 800%. So that's a systematic problem that will stay with us for a long time.
Just got 20 seconds. Be quick if you could. Ari, are you also seeing that the supply chains are going to be a little crazy and all over the place because people are
the supply chains is a big part of this as well. So there's always disruptions that happen, and you need data. That's the thing.
All right, we got to run. Ari, thank you so much. Ari Trosdahl, founder and CEO at Crisp, joining us here in our Interactive Brokers studio. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, so I guess if I can manufacture an iPhone, I can manufacture a car.
Sure.
Easy peasy.
I can make that leap.
We're going to talk about Foxconn. Interesting story. We've got actually a bunch of stories we want to pepper our Ed Ludlow with in just a moment. First up, though, back to the trade and your top business stories. Hey, Charlie Pellet.
Well, hello there. If we're talking Ed Ludlow, got to talk Apple. Indeed, you will. But Apple shares did turn negative a short while ago after the information reported that tech giant is cutting production of its iPhone 14 Plus, again, citing people with knowledge of the situation. Apple shares, they are higher now, up by about 0.6%. We do have the Dow, the S&P, and NASDAQ all advancing, trading well off session highs. Apple erasing gains. Netflix slumping ahead of its earnings report. S&P 500 trimmed most of a rally that did top 2% earlier in the day. Right now, we have got the S&P up 38 points. That is a gain of 1%. The Dow up 316, also up by 1%. NASDAQ up 84, a gain of 0.8%. As for the 10-year, it is now yielding 3.99%. The 2-year, 4.42%. Spot gold higher by $1 the ounce, little change, $16.51. West Texas Intermediate crude down 2.5%, $83.28 a barrel. Netflix reports after the close of trading, investors will be looking to see if the company makes good on its forecast for a return to subscriber growth after losing customers in the first half of the year. Geetha Raghunathan follows media stocks for Bloomberg Intelligence.
So I think sentiment obviously was at its weakest earlier this year. That we've seen a little bit of a change now in that sentiment. Things are getting a little bit positive, and that's really because Netflix has now, the narrative has kind of shifted away from slow growth or no subscriber growth to a business model that is going to be supported by advertising, and that's where there probably will be a lot of upside.
And again, we do have Netflix downside now, down 1.5%. Also reporting after the close of trading, UAL, United Airlines Holdings, up 2.7%. And JB Hunt, JB Transport Services, that is the trucking company, up by 1.3%. Recapping, S&P up 1.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, good stuff. We appreciate that, as always. We love talking about electric vehicles here. Matt Miller really likes talking about electric vehicles. I think pretty much everybody likes talking about it because it's such a cool new technology.
Have you bought one yet?
No, but I did test drive the Ford F-150 Lightning. Matt arranged that for me, so I had it for 4 days. It was awesome. Cool. Awesome. Just couldn't believe the technology of the electric vehicle. But somebody higher up at Bloomberg, really smart person somewhere, said, hey, let's do a weekly radio spot, and we'll call it Bloomberg Plugged In, our weekly look at the electric vehicles. Ed Ludlow joins us here, West Coast correspondent for Bloomberg News. Somehow he's been hanging around New York for weeks. I don't know what's going on, but he joins us here in our Bloomberg Interactive Broker Studio. I think
Do you not have a home anymore?
No, he says I'm nomad, So, anywho, Ed, let's talk about Foxconn.
Sure.
You got this crazy story on the Bloomberg terminal. This is the company that makes iPhones, but you're not telling me they're going to make electric vehicles?
They are. And their theory or their thesis is simple. We know supply chains. We can build electronics on behalf of other companies. We can do it for electric vehicles. And what was fascinating on Tuesday, they unveiled 2 prototypes, an SUV and a pickup truck. And this is just 2 years after they first kind of announced they were going to move into EVs. But they have no Foxconn name at all. These are just reference points. It's them saying, look at what we can do. If you're a big name out there in the world of automotive, let us do this for you. Fascinating.
So basically, hey, we can design our cars, we can do all the engineering, the development, but Foxconn, go ahead and manufacture
Yeah,
it.
so I'll give you an example. Yulong Group is a Taiwanese automaker, and Foxconn builds a vehicle on their behalf. It just manufactures, assembles it, and then sells it under that nameplate. One of the questions put to Foxconn in the press conference around these prototypes was, when do you expect to build more vehicles than Tesla? The response, we hope to build vehicles for Tesla. And it's a really interesting way of looking at it because, think about Tesla, the market incumbent, how long it took them to get to this point, where they're just such a clear leader. Think about the struggle that Ford and GM are going through to transition from combustion engine to electric. What Foxconn is saying is, hey, we can make this happen a lot more quicker from prototype concept to mass production because of how we already operate within global supply chains.
So is there aspiration to get manufacturing orders, production orders from a Ford, from a Volkswagen?
I think so. So one of the models they unveiled on Tuesday was the Model V, a pickup truck. And they said that this pickup truck will be produced in Taiwan, Thailand, and the United States. But remember, there's no ambition here to sell a Foxconn or Hon High Precision, the publicly traded arm car.
Well, they know the U.S. market when they're talking pickup truck.
Right. So the idea is here that they try and find a willing buyer, somebody that's trying to get to market with a pickup and build it on their behalf.
Geopolitical concerns? I mean, with the tensions between the U.S. and China, you tell me how Ford is going to say to a Chinese factory or GM, go ahead, take it, run with it.
Right. Well, one of the advantage that Foxconn has is sort of global manufacturing footprint.
I mean,
right?
Apple does it already, so yeah.
Exactly. But there is definitely a concern here that what if they're not able to take that manufacturing base outside and supply chain base outside of mainland China? Think about what Foxconn's already doing here. Bought the former GM plant in Ohio that Lordstown, a startup, was struggling to get off the ground.
Right.
Foxconn came and said, we'll take this from you and we'll do it on your behalf.
Well, and I also think about the legislation that was just passed with EV vehicles, but it had to be vehicles, right, that are made here in the United States. And there's a move, I think, is it France looking to do maybe the same thing? Yeah, we'll give you a credit, but it has to be made in Europe or something.
I think part of it is that China's electric vehicle industry is much more mature. There are many more players, the supply chain's mature, but think about the hold they have over the commodities market as well as some of the IP competition that's going on around chips. So it's definitely an area that people are jostling. But Foxconn certainly has ambitions to build within the United States. They're just saying, here's some cool things we've done. They're flexing. This is what we can do. How about we do it on your behalf?
It just made clear to me, and I just kind of today, because I was talking to Matt Miller about this, how do you differentiate between different EVs? Like, it's not like internal combustion, where it's the different engine type, there's turbocharged, blah, 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 blah. Here, it's just a shell and an electric motor. I guess it's a question Matt was telling me, how much battery power you want, which can go to range and things
it's also
like that.
a trade-off cost price versus what the EV can do. Teslas are amazing. They certainly have an advantage in software, not just on self-driving, but when it comes to battery management. But Foxconn is saying, well, let's look at the other end of the scale and price. How do we bring an affordable EV to market with a more modest range? And let's be honest, Tesla has kind of given up on that objective. The idea of them working toward $25,000 EV has gone out the window.
Yeah.
But that's certainly what part of what Foxconn is offering here. We can do it for you at scale and cheap.
It's also somebody could help ramp up EV production, it sounds like, very quickly as like, right? And that demand seems to be increasing globally in a big way. Ed Ludlow, thank you so much. Don't go back home. We can just have your home on the East Coast. Bloomberg News West Coast correspondent Ed Ludlow here in our Bloomberg Business Week studio. All right, coming up, let's get back to World and National News. For that, it's back to Denise Pellegrini. She's in our business newsroom. Hey, Denise.
Thank you, Carolyn. A fifth person has died in this week's Russian kamikaze drone attack on a residential building in Kyiv. Neighbors calling it part of a wave of Russian. Kevin McCarthy says Republicans will move to cut aid to Ukraine if they dominate Congress after the November elections. Democratic Virginia Senator Mark Warner, though, pushing back on that.
I do fear that there is this Trump-led America alone contingent that could have greatly increased power in the House, and a Republican House next year could undermine that support.
And Warner there on Bloomberg Balance Power. And the Biden administration announcing $15 million in new grants to treat mental health and addiction authorized under the bipartisan Safer Communities Act. Democrat Senator Debbie Stabenow of Michigan.
When you count the other services and schools, the hotline, everything else that is in there, is the largest investment in mental health and addiction-related services ever in our country.
And these funds will be combining with other programs for community behavioral health clinics. And today is the first day that states can apply for that fresh funding. It is considered groundbreaking, and we're tracking it all for you here on Bloomberg Radio. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini here on Bloomberg Markets. We're tracking it all for you. This is Bloomberg.
All right, Denise, thank you so much. Denise Pellegrini with World and National News. Check out shares of Apple. I know Charlie's been talking about it, Paul, but man, what a swing, about a 4.5% swing. And right now the stock, we saw a little bit of a dip on news of, after the information reported that the tech giant cutting production of its iPhone 14 Plus, citing people familiar with the matter, but the stock's off its lows.
Yeah, it's interesting. The information is reporting that they're actually cutting production. Bloomberg late last month reported that Apple is backing off plans to boost production of the iPhone. So this takes it a step further.
Yeah.
Not only is Apple reportedly not going to boost production in the second half of the year, which was originally thought, but the information is now reporting that they will actually cut production. So that kind of goes to that, obviously, the demand picture for this iPhone 14, which Anurag Rana told me he's waiting a year for the next one. The next one's supposed to be a bigger upgrade, and so this one he was not going to go buy.
Every time a new phone comes out, I'm like, Mark Gurman, is it time for me to upgrade?
Yes.
Because I'm always like, and he'll be like, nah, it's incremental, or like da da da. And so I may wait another year.
Yeah, so it's interesting, but they had some new products this year. Redesigned entry-level iPad. That's the first one in 5 years.
It's a long time.
Yeah, a new space, particularly in tech world. I mean,
Right.
It seems like we were getting them every year. Also, Mark Gurman's reporting that a new speedier Pro model and a cheaper TV set-top box seeking to entice consumers as it heads into what's expected to be another record holiday quarter. So gadgets always sell.
I agree with you. And I feel like whenever Apple reports, even if there's some disappointment, it always is these massive numbers and billions of dollars in sales. And I find it also increasingly interesting how they're, making their own chips, using their own chips. I mean, they are just all in on every aspect of it. By the way, Apple reporting October 27th, after the closing bell. So we'll look for those
The numbers I like for Apple are 180 billion in cash sitting on the balance sheet and $107 billion of free cash flow. I mean, and for a year. Free cash flow, it's just extraordinary. So those are the numbers that kind of jump out at you, Apple. So some new products driving the top line for Apple. Love more. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The S&P 500 index on track for back-to-back gains. We have got the Dow, the S&P, NASDAQ 100 index all advancing here. Choppy session. Stocks are well off session highs, but still, we've got the S&P up 38 points higher now by 1%. Best level of the day. The S&P have been up by 2%. The Dow up 313 right now. That is a gain of 1%. NASDAQ up 87, higher by 0.8%. The NASDAQ 100 index is pushing higher as well, up by 0.7%. 10-year yield right now, 3.99%. We've got the 2-year yielding 4.42%. Spot gold up 0.1%. 16.50 the ounce. West Texas Intermediate crude down 2.6%. WTI right now, 83.14 a barrel. Earnings after the closing bell will include Netflix. Netflix right now down 1.7%. We'll have details as that number breaks. United UAL up 3% ahead of earnings after the bell. J.B. Hunt, the trucking company, rolling higher now by 1.1%. So again, recapping the Dow, the S&P, NASDAQ, all advancing. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. It is 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Russia's efforts to use natural gas exports as a geopolitical weapon present Europe with a challenge. When faced with such a threat, can it muster the solidarity required of a true union? After all, Vladimir Putin's energy cutoff is a classic external shock that will hurt some European countries more than others. No doubt, efforts to expand risk sharing will face strong political headwinds. But at the very least, the EU should be able to establish a permanent fund to provide loans and grants in emergencies. Ultimately, what's needed is a central fiscal authority with its own revenue source and the power to spend when needed to mitigate asymmetric shocks. If a hybrid war with Russia can't bring the EU to even consider such a possibility, it's hard to imagine what will. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, this is a very interesting situation. Continental Resources. Shale billionaire Harold Hamm's latest offer to take Continental Resources private is still too low. That's according to Smead Capital Management, the oil explorer's largest minority investor. Hamm on Monday boosted his all-cash offer to $74.28 per share, but Smead believes that they should be paying about $90 per share. Let's check in with Cole Smead, president and portfolio manager of Smead Capital Management, joining us on the phone from London. So, Cole, give us, kind of what you think is going on with the company, with their board, with management, vis-a-vis their offer.
Yeah, it's a great question, and thanks for having me on. So, you have to remember that first off, Harold Hamm is nothing short of a genius in this space. And he's built himself an incredible net worth, and he in many cases has deserved that out of his hard work and understanding the business and being way more aggressive than anyone else. And those were all the reasons that we were interested in the business. Now, with the offer he threw in, he's a great card player. It's the kind of person you don't want to be across the table from when you're not on his side. And he threw in an offer that we assumed that he hoped oil prices would back off on. Obviously, not enough, because he had to raise the price, which we knew was going to be likely. The difference, though, is he raised the price just to please the special committee. It doesn't mean minorities agree with this. It doesn't mean that this is the true value of the business. When we say 90, that's what we kind of expect in a fair deal versus what do we think the business is worth? We think it's worth over $100, just so you're aware.
So I'm looking at the shareholder list here on the Bloomberg terminal. HDS is the symbol when you load in the ticker. I got Harold Hamm, 43% of the outstanding, and then lots of other various trusts and family members here. So they control this thing. What's the recourse for minority shareholders here?
It's a good question. So when this deal was originally announced in June, we had reached out to the special committee's counsel to make sure we get the chance to engage with them, as well as speak with their financial advisor, which was publicly disclosed finally that's Evercore. Now, that was communicated to us by their counsel. Just so you're aware, that never took place. We never got to talk to either the special committee or the financial advisor. And so when we saw this announced, it was contrary to what we had communicated to us as the largest minority. We provided 5 things that we were interested to find out where we felt that Continental poorly disclosed. Why can they poorly disclose? Because to your point, when Harold's your largest shareholder and his family controls the business, you don't have to disclose much because you're the shareholder. And so we're still interested. They'll have to provide a filing here in the next couple weeks or so off of what they're going to be providing in the tender. And we're interested to see the process that the board did or didn't do. We're interested to find out if the 5 things we flagged to them were actually even considered, because if they're not, you can kind of start to see a dialogue where they might have followed a process to not have a conflict. The question is, did they do their job?
So how far do you take this?
Well, I mean, it's an Oklahoma corporation, so it doesn't follow Delaware Chancery Court. What is particular to Oklahoma is their special appraisal rights under Oklahoma law, where we could take them to court and prove a higher valuation ultimately. So we're interested to see, like I said, what they're going to file in following this. But we have to see those documents first, and we'll probably ask for further information if there's not enough disclosing that. We again, for how poorly we've been treated in this process so far, I will not at all be shocked if that filing has almost nothing in it, because again, this looks like it's a homer. I mean, you're playing an away basketball game. You ain't getting any calls. It's
Cole,
the refs aren't on your side.
A couple things here. Having been through this process a few times, the bankers have to do comparable valuations. They have to justify the valuation. It has to trade in line with recent deals, with recent public trading. So you have to do all that type of stuff, number one. Number two, I look at the price chart. This stock's never been north of $80 a share, ever. So they could probably be saying, why should I pay $100?
Well, except that they'd also never owned the Pioneer assets that they bought for a song less than, roughly about 12 months ago. It was disclosed in the quarter that deal closed, that asset produced $150 million of free cash. That was a year ago with obviously lower oil prices. So what I don't think either the Wall Street analysts that covered the stock really understood, I think Ham get this, we get this, is that this ain't a cash cow. I mean, what he could do to lever this thing as a private business, he could borrow every nickel of the $4 billion he needs. So, again, he's a great card player. He's not going to give you anything close to fair because it's about Harold Hamm in this transaction. It's not about anybody else, and that's where we disagree. That's where our interests finally don't align.
How do you think this is going to play out here? What's the most likely time frame, I guess?
And is there a number you would come down to that's a little bit off your number, but a little bit closer to his number?
That's all part of the process, I guess. And we're, like I said, we're just interested to see what that process was. For example, if someone said, Cole, what would you expect out of this? We would have expected someone to come in and offer. In his filing in June, he said he was not interested in anyone else's offer. Now, he's frustrated that his stock is not being valued like it should be. But he's right in that. We agree with him in that. An all-stock deal from Devon Energy would have been really interesting to us because they have a lot of crossover, same geography as Continental Resources. And what Ham could be is their large anchor shareholder that Devon doesn't have. And what both companies are doing, in a way that I wouldn't do, is they're paying too much in dividends. They should be buying back stock. Ham couldn't do it because he'd be buying too many minorities out. Devon can't do it because they can't find any courage right now. But that would be our dream deal.
Hey, last thought and last questions. I mean, you have a bunch of energy names among your top holdings. Is there a big macro play here for you? I mean, we've certainly seen energy being the outperformer by a mile, wide margin this year, and just got about 30 seconds, Cole.
Yeah, no, the energy looks like the easiest game in town in a 10-year period where stocks are going to do terrible. This looks like the 70s. This looks like the 2000s. If you want my other big idea, in our international portfolio, we own MEG, Synovus buying Meg looks pretty attractive. We own Synovus as well. We also own Oxy, so we love Buffett being around. We love having billionaires being interested in our ideas.
Who doesn't?
Yeah, exactly.
Cole Smead, fun to spend some time with you and really dig into your holdings, Continental Resources. Cole Smead, President and Portfolio Manager at Smead Capital Management, joining us on the phone from London. By the way, that Smead Value Fund has beat just about all of its peers over the past 5 years, returning on average nearly 12% annually.
And that's saying something. I mean, value's been great the past couple and a half years, but before that, oof.
Yeah, right, to see that longer out performance there. All right, folks, time to head over to our TV colleagues. It's time for Beyond the Bell on radio, TV, and YouTube.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, and here to help take us beyond the bell. It's our simulcast, global simulcast. Carol Master, Paul Sweeney in for Tim Stenovic, and we welcome our audiences across Bloomberg Television, radio, as well as on YouTube. A close of the markets, and now the setup, Carol, right now for Netflix earnings going to cross the wire any minute now.
Yeah, I'm kind of glued to our live blog, just waiting for those numbers to cross. In the meantime, we've had a green day, but it's been a volatile one. And Paul, we've definitely been bouncing around here on the equity side of things.
Yeah, we're going to end up in green, but we had some really strong gains here this morning. Lost a little bit of the momentum, but found it again. But as Romaine was mentioning, the street will be really focusing on Netflix. How many subscribers did they add? And tell us about this ad-supported tier.
Paul, we love having you on days like today, parachuting you in, because of course this is your huge expertise, and we get to leverage your knowledge from the sell side as well when we think about the fundamentals. And really, of course, Caroline, the way that this presents sort of the macro picture of another big bellwether, and now, of course, going to be a player in the ad space.
And the micro is starting to perhaps overtake some of the macro headwinds that we've so fixated on. But really, is this a question of fundamentals? Have we actually been more technically driven in terms of the bounce that we see across the benchmarks today?
Yeah, I mean, interesting to see what people are buying, whether it really is just about valuation or sort of that proverbial capitulation that we saw in that note out by Bank of America from that latest fund manager survey. Capitulation when it comes to investors, capitulation when it comes to the macro, and if you believe Michael Hartnett, capitulation when it comes to policy. Don't think we're quite there yet. Nevertheless, here are the closing bell numbers here. Dow Jones Industrial Average going to finish the day higher by about 1.2%. The S&P higher by 1.2%. The NASDAQ higher by 0.9%. And the Russell 2000, Carol, going to finish the day higher by about 1%.
Yeah, still pretty broad-based in terms of the moves to the upside. 451 names in the S&P 500 gaining ground today, Taylor. 51 lower, 1 unchanged.
And go ahead.
No, go ahead, Romaine.
Just keep an eye here on Netflix earnings. Should be crossing the wire any second now. Go ahead.
Yeah, we're getting some releases out here on the investor wire. We'll wait to get those, of course, as we think about that. In the meantime, we're getting a lot of stability within the bond market.
Here come the numbers. So we see Netflix not providing paid membership, Taylor. Forecast starting in fourth quarter. So overall, we are seeing that they were fourth quarter revenue of $7.78 billion. That is a miss versus to the estimate of $7.98 billion. Third quarter streaming paid net change up $2 million, a big beat, and of course, winning back all that they lost in the first half of the year. Romaine.
Here's your revenue number coming in for Q3, $7.48 billion. The year-over-year growth, that's about 16%. Not bad here. Operating income 1.8, and we should point out the operating margin right now at 23.5% here. The EPS number coming in at $3.19. We're going to get you some comparisons here, but two things jump out at me, Taylor Riggs. The first is free cash flow, negative 106. Right now, we're looking at free cash flow, and net cash provided by operating activities is positive, but only at 82 here. So an interesting mixed picture here for Netflix as they pivot now to what I guess is supposed to be a new ad tier and potentially a reacceleration in growth.
And one of the big questions from Lightshed Partners, Rich Greenfield, of course, is are you shifting your content strategy to reduce costs? When you think a look at the negative free cash flow number, what that means. Reading through page 2 here of the press release, Carol, and they talk a lot about, of course, again, U.S. dollar strength is a significant headwind for them of what they call them, and you're really looking at a sequential decline in the fourth quarter in their forecast entirely due to the strength of that dollar. And again, you wonder how that sort of is impacting the way they're able to forecast those numbers too.
Gotta say, for radio, TV, you can see it clearly, but the stock is up more than 8% in the after hours. And I'm looking at our live blog. Chris Palmieri, entertainment reporter, follows Netflix very closely. Revenue, earnings, subscriber gains are all a beat, Paul.
Yeah, the subscriber gains for this quarter came in at $2.4 million. The consensus was for, 1 million subscribers that came in at 2.4. So better on the subscriber number. We're not going to get any subscriber guidance starting next quarter. And that's the company saying we really want Wall Street to pivot away from the subscriber story and start looking at the revenue and the cash flow and the earnings story.
If that is the case, then, Paul, what is that story? $7.78 billion, that's the forecast. That's not really in line with estimates. In fact, it's a touch light. But more importantly here, at least on a quarter-to-quarter basis, doesn't actually represent a tremendous amount of growth.
No, it doesn't. But I think it's really going to be about the profitability here. We know that the U.S. market, which is their most mature market, is very profitable. And as more and more of their international markets mature, it's going to be a real profit story, assuming they can, in fact, keep a lid on those programming expenses.
Paul, I'm curious what you say. Top 3 of the press release, they say that our aim is to give prospective new members more choice, not to switch current members from their current plans. This is, of course, when they're talking about that ad subscription model.
Yep.
What do you make of cannibalization and, in their words, the lack of it?
It is a risk because I know what my subscriber revenue is. I'm not sure what my revenue model is going to look like. I can model it out, but I'm just not sure what my cost, what I'll be able to charge for an ad on Netflix. They're going to only air about 4 minutes an hour of ads versus maybe 15 minutes an hour in a network show. So it is an unknown model to them, and it's an unknown model to Wall Street. So it's going to be a little bit of a guess here over the next really couple of years, I would say, as they develop this advertising business.
What's interesting is, of course, what the first company to really be blaming dollar strength on a lot. They say since January, it will hurt the year revenue by about $1 billion, the dollar strength. And really saying that's the sequential decline in revenue for this quarter just gone entirely due to FX overall, Romain.
I think it's, and just to get away from the numbers here, I think it's interesting. They actually, some interesting commentary here about how they release new titles here. And they talk about sort of the bingeable release model and basically defending it, saying that, according to them, this is their words, it helps drive substantial engagement, especially for newer titles. It also talks about how it wants better metrics with regards to how they measure viewership, sort of similar to those Nielsen ratings, basically saying that it used something, I guess, familiar to you in the UK, Caroline, the Broadcasters Audience Research Board, and saying that they want to see a better accounting for how streaming services viewership on some of these streaming platforms. So interesting, and maybe this gets to Paul's point too, that this isn't now just about subscribers. They really want to show the impact of what they're putting out there, and maybe that is the story.
They say Squid Games would not have become a global momentum if we hadn't binged it and released it all at once. That's how they're thinking of building that momentum.
Let's get Geetha Raghunathan into this conversation. She's the media analyst for us down at Bloomberg Intelligence. Geetha, just tell us what jumped out at you most out of this report.
I mean, phew, what a relief here, seeing these numbers. I mean, they're finally back to growth, which is really good. And their guidance right now, again, pretty much in line. And what's really encouraging to me about that 4Q guidance is that they say that they've really not baked in any of those ad tier expectations. So there is potentially a lot of upside to that guidance as well. Remember, 4Q is one of their heaviest quarters. They have a huge lineup of big hitting content titles. So again, there's a lot of optimism in this report.
Well, and so what do you think specifically Netflix is trading on right now? Geetha continue to trade 10, 11% higher. The stock is down 60% this year. Is it that everybody was so negative on the company, or is there something very specific that you would point to here?
I think what everybody was kind of really worried about was, has subscriber growth really kind of hit that wall? And just the fact that they were, they did speak to a lot of those seasonal factors in 1Q and 2Q, just the fact that they've been able to kind of reverse those trends and more than deliver. They've obviously beaten guidance, beaten consensus estimates. And now you do have a very, very viable catalyst in terms of advertising. Some of the engagement metrics that they put out in that letter, those are huge engagement metrics. Those would be, that's a gold mine for them when they're trying to attract huge ad dollars, which is exactly what they're trying to do. So any advertiser would want to jump on that opportunity. And so this report really sets them up, I think, so beautifully for that launch of that ad tier.
How is this a read across the industry, as we're seeing Walt Disney, Roku, Warner Brothers all lifted on the back of this in after hours trading as well, Geetha? Or how much is this idiosyncratic, specific to Netflix?
I think a lot of it was specific to Netflix because we saw subscriber growth kind of completely stall at Netflix. Whereas we were seeing some of the other platforms actually report growth, but you have to remember they're all in different stages of their life cycle. So obviously Netflix is the earliest game in town. So they obviously had that huge first mover advantage. I think what it tells us is obviously there still are people, who are going to be willing to subscribe to the service. The market opportunity is still pretty much there. These streaming services just kind of have to find ways now, creative ways of monetizing their audiences.
They talk about competition, saying that right now their competition is still losing money as they pivot from linear to streaming. But then they say ultimately, we know that our competitors are going to build a sustainable, profitable business. What is the competitive landscape that Netflix is really addressing here?
Yeah, I mean, they are looking at some of their competitors, and we can, talk about Disney, of course. They have huge pieces of content. They've launched in almost all of the big markets. They just have huge, global IP brands. But then you look at some of these other competitors, and Amazon comes to mind. They've made some huge bets just in the third quarter alone with some of the pieces of content, whether it was a Lord of the Rings, for which they spent $700 million for just a single season, or whether it was Thursday Night Football, which again cost them over $1 billion. So, some of these big tech giants, especially with deep pockets, are unafraid. They are willing to go big. So Netflix has to be able to position itself well against all of these competitors, whether it's, the old media companies or some of these newer tech entrants.
All right, we're going to leave it there. Geeta, thank you so much. Geeta Ranganathan, who follows, of course, Netflix and the whole space for us. And so we're watching shares of Netflix here up more than 12.5% here in the after hours. All right, that's a wrap for our cross-platform coverage on radio, TV, YouTube, following Netflix into the after hours. And we will see you same time, same place tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on this busy Tuesday. Carol Masser along with Paul Sweeney in for my co-host Tim Stenovic. We're going to continue with Netflix because the stock holding on to its bump up in a big way in the after hours, still up about 11-12%. The big key headline jumping after third quarter subscribers beat expectations, and we've got a great guest to talk about it.
Yeah, absolutely. Let's bring in Dan Morgan, Senior Portfolio Manager, Synovus Trust Company. They've got $19.5 billion in assets under management. He joins us on the phone from Atlanta. So, Dan, a pretty solid quarter from Netflix. I know there's a lot of hesitation in the marketplace because this company's, about to embark upon a pivot away from strictly subscription revenue to one that's now going to include advertising. But pretty good quarter here.
Yeah, it looks like a really strong quarter. I mean, obviously, the numbers were ahead of expectations in terms of the number of new subscribers that they added. The street was looking for 1 million. They did 2.41 million. And I think the key number for me, guys, was I thought that estimate going into the fourth quarter, which was a little over 4 million, was way over the back fence, but they guided on this quarter that they're going to do 4.5 million in terms of number of new subscribers. So it looks like at least they're getting their mojo back, right?
Right.
After 2 consecutive quarters of negative subscriber growth. And of course they, beat on revenues. Looks like they got a beat on EPS. So overall top line was only up 5.9%, but it was better than the 4 and change that everyone was looking for. So I think we have to walk away from this number with a sigh of relief. And that is, at least they didn't surprise us like they did last time, Carol,
right.
When they came in with negative growth. And I think you and I were trying to read the numbers, and we're not reading this right.
I think we were looking at it, right, saying, wait, is that a mistake? Is that a mistake?
Yeah.
So returning to growth, and we still don't even know about the ad-supported tier, right? Because we haven't gotten numbers or forecasts on that yet.
Yeah, I mean, the ad situation is interesting because, Netflix was always reluctant to go that route. Then they got kind of forced to do it because Disney Plus and HBO have both gone that route. My understanding is it's going to be between roughly $6 to $8 per month. They're only going to do advertising breaks maybe 3 to 4 times during an hour program. So it'll be interesting, though, because, my concern is, guys, are people that are paying $25 a month going to just go, I haven't really ordered any new DVDs over the last couple of weeks. I'm just going to shuttle down to this new $650 ad-supported model, and I'll just kind of leave the room when the ads come on. So, it's not a guarantee this is going to work.
You know, Chris Palmieri from Bloomberg News is reporting that Netflix bought an ad in tonight's opening night of NBA basketball, I think on TBS, teasing some of their sports programming. You know, they have some documentaries and things. Do you think, Dan, that Netflix will ever kind of jump into that big sports rights business, and we'll see NFL on some of their streaming?
Yeah, you know what's interesting? We've had other people try to do that, right? Twitter tried to do that. Do you remember that? They were covering some NFL stuff like Monday Night Football or Thursday Night Football, and it never really seemed to pay off for them, right? They couldn't get people to stay watching it. So I don't know if that's really Netflix's game, but I guess they're trying to play with it a little bit and see if people will bite on it. To me, it's still guys going out there spending $17 billion a year, getting those series that last forever and hooking you to stay on board. But we'll see if they get into the sports game. It'd be interesting if they did.
Well, you know, we talk about law of large numbers here. I mean, their content slate, and I love our live blog, in the third quarter, especially strong. Fourth season of Stranger Things generated 1.35 billion hours viewed. That was followed in August by The Sandman, 351 million hours viewed. They talk about Cobra Kai, 270 million hours viewed. And Monster, the Jeffrey Dahmer story, 824 million hours viewed, the second largest English language series ever. I mean, you know, Dan, they have been so much about content. We constantly talk about content. Well, they've been giving it to us.
Yeah, you're right, Carol, and I think that's really showing up in these subscriber growth numbers, right? And the fact that they were offering these shows that people were watching. I mean, boom, they doubled the estimate, right? 2.4 million compared to a little over a million. So I think we're seeing that come into play here in regards to the fact that content is driving that top line membership, number.
And Dan, what's the lay of the land, do you think, of the competitive environment? Because we've got Disney and pretty much every other media company out there with a streaming service, and they all seem to name them a plus. I'm not sure why, but so there's competition out there.
Yeah. You know what's interesting is you look at these companies, you put them all together, right? You look at Disney Plus, you look at the new spinoff, right, which was Warner Brothers Discovery. You got Paramount Plus, Amazon, Apple. We put them all together. They're spending $10 billion in content between all of them just to compete against Netflix. And I don't know about me, but it's almost getting to the point where it's like the airline industry, right? Meaning it's so competitive, it's so hard. There's so much cost up front to getting the content. Everybody's fighting it out. I'm just wondering if some of these late entrants are going to be able to find enough space. I mean, right now, a third of the market is streaming, and it's increasing. But, it'll just be interesting to see how Netflix kind of stacks up in the future against these other. And if it starts to maybe clear down a little bit where some of these competitors just can't make it.
Hey, listen, we're also getting a heads up that Netflix will stop giving a forecast for subscriber growth starting next quarter. It will, however, continue to provide revenue, operating income, and net income guidance. What's up with that, and how do you feel about that as someone who's got to follow the company, and that's a key metric?
Well, it's really tough, Carol, because, this quarter they did guide, right? We said 4.5 million on the fourth quarter. That was above consensus at 4. So that made everybody feel really good about the stock.
Yeah, exactly.
And now all of a sudden you go into a little bit of a black hole where it's like, okay, well, I appreciate you guys giving me guidance on revenues and diluted EPS and net income, and that's all great. But how do I work those numbers out to come up with what your actual new subscribers is? It's kind of like with Apple, when they dropped giving the unit volume forecast on the iPhone, but we still all know what it is. We're all watching it because they back the number out. So I guess people have to do that with Netflix too.
And Dan, it looks like this company starting this year, I'm just looking at the FA function on the Bloomberg terminal, and they got some consensus forecasts, going to put up some free cash flow this year and then really kind of see that grow pretty dramatically over the next several years. How important is that for the stock? Or is this still a company or still a stock that's kind of driven by the top line?
No, you hit it on the button there, which is before it was growth at all cost, right? They were taking on a lot of long-term debt. They were running negative free cash flow just to drive that top line and get new subscribers through their shows. But now they're kind of retrenching back. And you mentioned before, this year the target for free cash flow is about roughly about $1 billion in positive free cash flow. They were running in the red before that. Content about $17 billion. And then as they move forward into 2023, they're looking for about $2.7 billion in free cash flow, and then 24, $4.1 billion in cash flow. So I think this sets the stage, Paul and Carol, for the future for them, which is how do you monetize the 222 million subscribers that you have, right? You want to generate all the cash flow. You want to be able to make as much money as you can off of them in case your subscriber growth starts to go down again. So this free cash flow number is huge because what do you do with free cash flow? You buy shares or you can issue a dividend, right?
That's right. It certainly gives you some breathing room. We got to leave it there. Dan Morgan, thank you so much. Senior Portfolio Manager at Synovus Trust Company, joining us on the phone from Atlanta. I love our Lucas Shaw writing, Netflix is growing again and Hollywood can breathe a sigh of relief. And you're definitely seeing it in terms of investors.
That's Lucas's beat, Hollywood. So, and he lives and breathes that.
He really does. And talk about sighing, and having some peace, because anybody who's trying to be bullish on this name, they're getting some happiness here in the after hours because the stock is up more than 14% here as we speak. So pretty much at its highs here in the aftermarket. All right, let's get back to some of the news after the closing bell. Those closing numbers on Wall Street. Here is once again Charlie.
I thank you very much, Carol Master. Indeed, Netflix, certainly the major story, the major earnings story after the close of trading, but a couple of other big, well-known companies also reporting. United Airlines out with adjusted EPS for the third quarter that also beat the average analyst estimate. United shares taking off after hours, soaring now by just about 9%, so we're keeping an eye on United. On the ground, trucker J.B. Hunt reported earnings per share for the third quarter that also beat the average analyst estimate. But again, though, Netflix, the major story there, as we have been reporting, an earnings beat from Netflix after our shares up by 14%. Back-to-back gains today for the S&P 500 index. Stocks continued their rebound from nearly oversold levels. Traders assess prospects for earnings growth against a backdrop of rising rates. 10-year yield 3.99%, 2-year 4.43%. The Dow, the S&P, NASDAQ all higher today, with the S&P up 42, a gain there of 1.1%. The Dow also up by 1.1% today. NASDAQ up 96, a gain there of 0.9%. Spot gold up 0.1%, 16.51 the ounce. West Texas Intermediate crude down 2.6% today, 83.21 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Just got to mention it. Netflix now up more than 15%. I can just see on the Bloomberg tomorrow the story is going to be like, Netflix, if it holds on to this, how much it's going to add to its market cap.
Exactly.
Because right now it would be a lot. Earlier this year, Bloomberg News reported on how female founders raised, Paul, just 2% of venture capital in the U.S. last year. That was the smallest share since 2016. And it's really a sign that efforts to really diversify the famously male-dominated industry, continues to struggle. It's an old story, unfortunately.
No, it's a frustrating one because there has been lots of efforts over the years throughout financial services to change that narrative around, and it just never seems to get that real traction, particularly in Silicon Valley.
All right, so we have a great guest on this and working on that gap that persists there between men and women, especially when it comes to raising VC money. Ruth Fox-Blader, she is partner at Anthemis. It's a fintech venture capital firm. She's lived and worked around the globe. She joins us on the phone from San Francisco. Ruth, good to have you here with Paul and myself. How are you? And first of all, let's just get to the crux of this. Why is it still so difficult for women to launch companies and access capital and get some help here?
Yeah, I think, and first of all, thank you so much for having me today. I think that it's a really simple answer in some ways to a somewhat complex question. The answer is really discrimination. And this is kind of systemic discrimination that women face and also kind of bilateral day-to-day discrimination. I think where I'm really encouraged is that I have a portfolio which is full of outstanding female founders. I am a partner in the venture capital practice at Anthemis, so a little bit against all odds myself. And I have a lot of optimism, but, also we have a lot of work to do.
And Ruth, one of the things when I think about the venture capital firm, you think of places like, Sand Hill Road out in Silicon Valley. It's just, it feels, it looks, it sounds very insular. Like if I can't raise my capital from some of those people out in the valley, I know it's getting better with Austins of the world and things like that, but boy, if I can't make it there, it's hard to make it anywhere in the VC world. Is that changing at all?
Yeah, I think it is, particularly for the sector that I look at, which is financial services. London and New York and Singapore and places, where the markets really have always been quite vibrant venture capital scenes. I think that the diversification, though, that you're talking about of venture capital and where it lives, the geographic diversification certainly has a role to play in diversifying the founders that we invest in. There's a sort of sense that venture capital came from a small group of people who were looking to invest in people that look like them. For me, this is just completely counterintuitive. Venture capital is a game of exceptions. You're looking for exceptional companies that are going to beat a lot of odds and really kind of, strange stories, interesting founders. So how would you get those exceptional outcomes if you keep investing in people that, look the same and have the same kind of pedigree? It doesn't really make any sense.
Somebody once said to me a few years ago that what you need is more women to create a Google or an Apple or so on and so forth, and then the money will come. Is that what it's about? Is it that simple or difficult?
No, there really are some exceptional female founders that have raised an enormous amount of capital and also run huge companies. So I don't think that we should, it's quite exceptional for anyone to build a company at that scale, right? I think we probably need more women in venture capital. This is something that I've been working on in a lot of different places, both at Anthemis and also in another organization that I've been working on in Europe. I think that female investors tend to back diverse founders. So I think this is one kind of simple Band-Aid solution, but I think it's also generally just a sense that venture capital and great ideas can come from anywhere and can really stem from any background, any diverse background. And probably the more diverse, the more likely people are to have outsized impact.
So, Ruth, I do a lot of work with Duke University's Graduate School of Business, and in their venture capital fund, their private equity fund, their alternative investment funds, teams, there's a lot of women represented. What happens, where do you tend to lose them, if you will? Where does it not translate? Because, again, I see a lot of demand at the university level.
Yeah, it's a tough question for me to answer because I really do invest in a much more diverse way than many of my peers. I think that, sometimes women will self-select out. This is something which has been studied and shown not only in venture capital, but in other fields, that there are certain demands or expectations of demands around building a startup where women feel like it's incompatible with other choices that they might make. Similarly, I've spoken with a lot of women on their path to partner in venture capital firms who say the same thing. Will this be compatible with having a family? I think it absolutely can be. I think we probably need some more support structures and also kind of deeper understanding amongst the LP and GP world of what it takes and how we can create support for exceptional people to bring exceptional ideas to life. It's really never the founder alone who does that. So how do we help founders create teams which are more sustainable and allow them to achieve a lot of their different goals and objectives? That could be, one answer. I think, obviously there's also just a funding gap.
Yeah, we certainly see it continue to play out. Ruth Fox-Blader, partner at Anthemis, joining us on the phone from San Francisco. Continue to watch Netflix. It's up just shy of 14% in the after hours following earnings. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on this Tuesday live in our radio studio and, of course, on YouTube. Coming up, it is among the most read stories on the Bloomberg. We're going to talk about the COVID billionaires and where they are now. We'll get to that in just a moment. First up, back to your top business stories. A lot of earnings after the close. Big ones, Charlie.
Indeed, absolutely right about that, Carol. Got to begin with Netflix. Shares surging now by just about 14% after ours. We've got Netflix rallying, Hollywood breathing a sigh of relief, as Wall Street is as well, with the streaming leader adding 2.41 million subscribers in the third quarter, exceeding internal forecasts as well as expectations on Wall Street. Dan Morgan is Senior Portfolio Manager at Synovus Trust. He was our guest right here on Bloomberg Business Week.
It looks like at least they're getting their mojo back after 2 consecutive quarters of negative subscriber growth. And, of course, they, beat on revenues. Looks like they got a beat on EPS. So overall top line was only up 5.9%, but it was better than the 4 and change that everyone was looking for. So I think we'd have to walk away from this number with a sigh of relief.
And also sifting through the numbers after ours, Geetha Raghunatham, who follows media stocks for Bloomberg Intelligence.
They're finally back to growth, which is really good. And their guidance right now, again, pretty much in line. And what's really encouraging to me about that 4Q guidance is that they say that they've really not baked in any of those ad tier expectations. So there is potentially a lot of upside to that guidance as well.
And again, after our shares now up by about 13%. Stocks today regain lost ground with a back-to-back rally. S&P 500 index up 42 points, up by 1.1%. The Dow today up 337, up 1.1%. NASDAQ up 96, a gain there of 0.9%. The 2-year yield, 4.42%. The 10-year, 4.00%. Spot gold up $1.38 the ounce to $16.51, up by 0.1%. West Texas Intermediate crude oil today fell 2.4%, now at $83.40 a barrel. Very briefly after ours, also keeping an eye on UAL, United Airlines, reporting adjusted EPS for the third quarter that beat the average analyst estimate. UAL shares up by roughly 9% after ours. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Yeah, quite a boost in both United and Netflix following their earnings. All right, something will follow certainly into the Wednesday trade. Hey, listen, I do want to get to the Bloomberg Big Take, and it is a most read on the Bloomberg, easily a most read, and it has stayed atop the list. And you can understand why with a headline like this, with more on the extraordinary rise and fall of the COVID billionaires. Let's get to Brian Chapata. He's Bloomberg News, America's Wealth Team Leader, and he's here in our Bloomberg Interactive Broker Studio. The Big Take, by the way, you can find it on the Bloomberg and at Bloomberg.com/Big Take. Incredible story, and I feel like we have spent so much time talking about kind of the pandemic economy and those who benefited, and the post-pandemic economy, which has brought a lot of those who benefited, the people who run those companies, who were made really wealthy. Their wealth looks a lot differently on the other side of the pandemic.
Yeah, it was really interesting. This was a whole collaboration with the wealth team globally. We have our Bloomberg Billionaires Index, of course, which tracks all the billionaires out there. We identified 189 of them that their wealth doubled between December 31st, 2019, and at some point in 2021. And of those, we identified 58, which we determined were called COVID billionaires because they were directly based on the pandemic, helped their fortunes rise, right? So it was really interesting. It's kind of hard to visualize the graph over radio, but you can just see the super surge in wealth.
Looks like a good mountain to ski.
Yeah,
basically.
But I mean, it's more than a black diamond on the way down. I mean, it's pretty incredible, honestly. Their precipitous decline, basically since October, November of last year, once there was kind of a flip, in part because of the Federal Reserve, but also because the Delta wave was receding, and all of a sudden, all these fortunes that were made suddenly evaporated in a hurry.
Yeah, I feel like, Brian, we talk about that, whether it's a Peloton, a Zoom, or the most logical. Let's talk about like the pharmaceuticals, and I think constantly I still find myself talking a lot about Moderna. It's often a biggest gainer or a biggest decliner, depending on the market day. Let's talk about the head of that company because he made a lot of money.
Yeah, I mean, you can look at the peak net worth during COVID $15 billion, and now the net worth as of September 30th was 3.7. That's a decline of 75%. He was just another scientist.
Stéphane Bancel.
Yes, from France. He was just another scientist kind of trying to make his way, and all of a sudden in Massachusetts, obviously the biotech capital of the country, and then all of a sudden COVID hit, and suddenly, he had the technology to kind of make a vaccine, right? So as we've seen, there was a huge push into Moderna. The stock price soared, but ultimately, now it's come crashing back down because obviously COVID's receding a little bit.
Yeah, it was pretty fascinating. I felt like it was a company that really wasn't on anybody's radar, and the company, as well as their CEO, was everywhere. And I know we all talked to him a lot. Zoom is another one that was this incredible pandemic play, and it's still a big part of people's lives, but maybe not as much so.
Yeah, I think one of the interesting things when you think about Eric Yuan, who runs Zoom, is that he gave away actually a good portion of his fortune kind of around the peak, and that's kind of one of the things that we've been interested in is, when you look back at these past 2 or 3 years, the tremendous fortunes that were made. I mean, they were all on paper, right? Like, what did they do with them? So you look at Eric Yuan, and he gave away actually a good portion of his fortune, which is good because his net worth change is down 84% since the peak. Another person who is interesting to watch is Ernie Garcia of Carvana. He's another one of our COVID billionaires. Obviously, if you can't go outside and you need to get a car vending machines that are delivered straight to you is a really good business model. Who would have thought? But he actually started selling a bunch of shares kind of around the peak in summer of 2021. So that's another one where he actually cashed in on some of those paper gains.
Talk to us about maybe some of the not so familiar maybe to the Bloomberg audience, but I think of whether it's some of the big CEOs over in Asia that actually also just hit it big during the pandemic.
Yeah, I mean, I think about Bom Kim of Coupang, and often dubbed Korea's Amazon, right? I mean, that sticks out obviously. You saw how Jeff Bezos' fortune surged during the pandemic. If you're trying to order things from home and not go outside, again, that's the perfectly set up company, and it's just the tale of a lot of these companies. Is just they were in the right place at the right time for an unfortunately really tragic pandemic.
Right.
And so you've seen the tremendous surge in fortunes, but then, I mean, now that things are getting back to something resembling normal, all of a sudden, nobody really, no one wants to Zoom anymore. We'll still Zoom, but, it's not necessarily going to be the end-all, be-all of conferencing.
This is what you do. You guys track the billionaires and their wealth, and it's really, pretty dramatic to see what some people had made of the, height of the pandemic and then coming down on the other side of it. But you have a stat in the story, too, that says there are now about 97 million more people living on less than $1.90 a day because of the pandemic, and that's a World Bank report. There's the other side of this, just quickly.
Yeah, I mean, that's kind of the other thing, right? Is that COVID has been really rough for a lot of people, and it just exacerbated inequality to a large part. Even though stocks have come back down, a lot of the people who had a lot of money in the stock market made a ton of money, and whereas other people were a little less fortunate.
I do feel like one of the stories that we constantly talk about is the increasing gap between the have and have-nots. It's always there, but it's really gotten a much bigger divide. Brian Chapata, incredible reporting, and as I said, among the most read, and it's a Bloomberg Big Take. Brian is America's Wealth Team Leader at Bloomberg News here in our Interactive Broker studio. All right, back to World and National News, and Denise Pellegrini. Denise, all yours.
All right, thank you, Carol. Got a question for you. Does it seem more crowded out there if you're in Manhattan today? Because Castle Systems says office occupancy in Manhattan has just hit the highest level since the start of the pandemic. Massive white tents opening on Randall's Island today. It is temporary shelter for migrants from Central and South America. President Biden promising American voters if Democrats keep control of Congress, he will ensure abortion is legal across the country by law.
The first bill that I will send to the Congress will be to codify Roe v. Wade. And when Congress passes it, I'll sign it in January, 50 years after Roe was first decided the law of the land.
And Biden speaking at an event hosted by the Democratic National Committee. Senate Democrats say if the GOP dominates in the coming midterms, Ukraine's efforts to repel Russia could be hurt. Virginia Senator Mark Warner.
I do fear that there is this Trump-led America alone contingent that could have greatly increased power in the House, and a Republican House next year could undermine that support.
And Warner with us there on Balanced Power. And House GOP leader Kevin McCarthy says Republicans will pull back on aid to Ukraine if they do gain control of the House. McDonald's testing new treats, offering Krispy Kreme donuts at some of its stores as handhelds and also in 6-packs. McDonald's trying to offer cheaper menu items for cash-strapped consumers. And United passengers at Newark Airport reporting a snake on board. No one injured by that non-venomous snake, but passengers did report hearing some shrieking from business class as the flight from Tampa taxied to the gate. And as we've been talking about, some shrieking at Yankee Stadium in baseball right now. Yankees beating Cleveland 3-0. Global News, I'm Denise Pellegrini. This is Bloomberg.
Yeah, they're shrieking on Madison Avenue because the stores are back.
Yes, the stores are back. So more stores are filling vacancies on Manhattan's Madison Avenue, a sign that the key shopping corridor is starting to bounce back after the pandemic. Natalie Wong and Christian Ritchie have that story. That's good. I mean, because, boy, you just thought that was one of the areas that was
immune,
exactly, but it was not, certainly.
Well, I have to say, for anybody who's not a New Yorker, right, and not familiar, I mean, Madison Avenue is rather posh. It's very high-end. It's very exclusive. And
depending upon tourism for a big thing.
Exactly. And if you have to ask, like, you probably shouldn't be shopping there. But we thought it was pretty immune. Retail tenants apparently have been snapping up spots on Madison Avenue, pushing the available space down to roughly 18% in the third quarter. And, Paul, that's the lowest since 2018. This is according to a report by Jones Lang LaSalle.
Okay. And just a little bit closer to home, a couple blocks closer right here at the Bloomberg office, we're on Lexington Avenue between 58th and 59th, and there's lots of retail space on the ground floors of all the buildings in our little block here. And basically, I would say 80% left, 90% left. The only thing that stayed was this little Swiss chocolate company that survived.
Which often, at the end of the day, I buy a little chunk.
I think it thrived. It's always people in there. Even when the pandemic had us kind of shut down, people were masking up and social distancing just so they could get their chocolate. But everybody else left. Now we're starting to get some of those spaces filling up again, which is good news.
Well, even our Bloomberg News team wrote about this area in particular because Banana Republic's gone, Gap is gone, Victoria's Secret's gone, the Container Store, H&M left. I mean, it's unbelievable.
And the other story we did earlier about, the office buildings are only about 50% occupied with workers. And I don't know if that number materially changes in the next few years. I would believe that maybe it would not. And so the businesses that depend upon that, what do they do?
I don't know. I mean, I know you're a big believer in, like, come in, just get back to the office at this point.
Yeah, I'm out of it. I'm glad I'm not managing anybody these days.
It's not easy because there is definitely some different feelings among different populations about getting to work. I think it's going to be flexible, but we'll see longer term. All right, you're listening and watching Bloomberg Business Week right here on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Streaming leader Netflix growing again. It is getting rave reviews after hours from Wall Street. Shares up now by 13.5%. Netflix added 2.41 million customers in the third quarter, exceeding internal forecasts. Also moving higher, United Airlines. It's out with adjusted EPS for the third quarter that beat analyst estimates. UAL after hours up now by about 7.5%. Trucker J.B. Hunt reported earnings per share for the third quarter that also beat estimates. Shares of J.B. Hunt right now looking on the Bloomberg up by about 2.9%. The Dow, the S&P, NASDAQ all advanced today. Back-to-back gains for the S&P 500 index. Stocks regaining some lost ground. S&P up 42, up 1.1%. The Dow today up 337, also up 1.1%. NASDAQ up 96. That was a gain of 0.9%. 10-year yield 4.00%. Spot gold up 0.1%, 16.52 the ounce. Bitcoin down 0.6%, 19,407 on Bitcoin. And West Texas Intermediate crude down 2.3%, 83.53 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Bloomberg Business Week is brought to you by SEI. Imagine your asset management firm's operational infrastructure as a competitive advantage. Let SEI show you how at SEIC.com/IMS.
All right, you're listening and watching Bloomberg Business Week. Carol Massar, along with Paul Sweeney, Tim Stanovic will be back tomorrow. In the meantime, this is something Paul and I have been talking about a lot, about use of office space, hybrid working. And our next guest in this company have found out that an overwhelming majority of CFOs are cost-cutting amid rising inflation and recession concerns. So does this mean bye-bye corporate offices?
Exactly.
All right, with us via Zoom from the gorgeous Principality of Monaco, Mark Dixon, founder and CEO of IWG, International Workplace Group. Hey, Mark, good to have you here with Paul and myself. So tell us about the growth that you guys are seeing, because I think you're at, 8 million and growing across more than 120 countries. Tell us about the metrics so we can all understand what's going on in terms of how people are working.
Well, look, this is a change that began pre the pandemic. Companies were already changing, making more use of technology, working more remotely, working in a more distributed fashion. The pandemic accelerated the adoption of this new way of working, and it's continued to grow after. As you said, CFOs today are, they're reviewing any costs they can cut. They feel there's a recession coming on in much of the developed world. Workers are asking for a different way to work, and the focus on cost cutting, and then a focus on delivering what workers seem to want, has meant that more and more companies are adopting hybrid working. That is, allowing people to work closer to where they live. I mean, the real change here is that people just are reluctant to commute. They're reluctant to spend an hour, 2 hours, sometimes 3 hours a day commuting at great cost to go into an office to use a laptop, a computer, which they could have done from an office down the road. So it's a radical change, and it's a change that is affecting many, many companies and many people.
Hey, Mark, I'm in the old school that kind of sees the benefit of coming into the office and building that camaraderie and so on. But I fully understand the other side because, boy, the productivity of the global workforce, and here at Bloomberg, we focus a lot on Wall Street. Just the Wall Street industry was able to be so productive while working from home. It just blew me away. I mean, that probably as much as anything is an argument for embracing some kind of hybrid work or work from home. Were you surprised by the productivity?
Yeah, well, look, I've said this many times. Companies didn't fall over during the pandemic. They didn't fall over because their workers didn't come to a central office. And productivity for many companies improved. I think, look, just coming to your comment on camaraderie, very, very important is the psychology of the workers themselves and making sure they're at their most productive. Now, modern companies, the most advanced companies, are adopting hybrid work, but they're not just using as a way to cut costs. Look, hybrid work will reduce your cost by at least 50% and reduce your carbon footprint by 70%. That's well rehearsed. The numbers are very clear. But companies reinvest some of that money into better workforce management, bringing people together more regularly, investing more in people, as opposed to investing more, invest less in real estate, more in people. And we've talked over the past year about things moving from real estate to HR. The whole emphasis has moved.
So so Mark, let me just jump in because we've only got about 3 minutes or so, but you are incredible and I love talking with you. The thing is, though, you point out that this hybrid model was starting before the pandemic. Pandemic definitely accelerated it. And I do wonder if coming off the pandemic, it's at the same rate of what we saw in the pandemic, it's back to pre-pandemic levels, or is it picking up some momentum? I'm trying to get an idea of if increasingly people are leaning into this hybrid model. And you see it directly because you guys you continue to expand. So give me an idea.
It's picking up momentum. Look, it's the economics of it that really move it. Companies are extremely focused on their cost base, for obvious reasons, both rising costs and potentially a recession coming up. Their workers are asking to work in a different way. So, it's the economics and the demand from workers, and everyone wants to hire the best workers. Those two things are driving rapid change. So the adoption is increasing, it's not going down.
Mark, how about compensation? If I'm a tech CEO and I pay my worker in San Francisco a certain wage, and then he or she, kind of relocates to Iowa, do I need to pay the same wage?
Well, that's a very good question. Look, the whole of this new way of working is developing and developing quickly. The protocols of how you operate a company in this new way are just being developed as we speak, as more and more companies adopt. But yes, there is a variation sometimes in salaries, but in the end, what it comes down to is productivity. So, and efficiency in actually carrying out a task for a company. So it's a new world. It's developing quickly. The software is there. The backbone of all of this is the internet and the software behind it. And the protocols as they develop, it will adjust things like pay.
Hey, we just got about 30, 40 seconds left here, Mark. Might the pressures on companies to continue to reduce their carbon footprint, might that be another big catalyst over the next few years that forces more companies to do more hybrid? And again, just got about 30, 40 seconds here.
Yeah, definitely. I mean, I think the elephant in the room is the environment. I mean, basically costs come first, but the environment and sustainability is also an important driver. Moving to hybrid will reduce carbon footprint by about 70%, and it improves the overall ESG scores on many things, including workers' contentment and happiness.
Yeah.
So definitely a driver.
Yeah, you definitely feel it with, a lot of workers who say, I want more balance. I don't want to be spending time commuting for, hours, and I want that flexibility. Mark, always welcome. Love to hear from you. Mark Dixon, founder and CEO at IWG Global International Workplace Group, joining us via Zoom from Monaco, right? Like, it makes you think.
Yes, it certainly does. I mean, it's tough to argue against. It really is. And I'll be interested to see how this really evolves and whether different industries embrace it differently.
Yeah, and, workers growing out of the pandemic, just saying this is the way I want to do it. Hey, folks, Netflix shares still up just shy of 14% in the after hours. Shares of United Airlines, UAL, up about 7%. Paul Sweeney, always love having you.
Always love being here.
Catch Paul in the morning on Surveillance and on Bloomberg Markets. Have a great and safe evening, everyone. This is Bloomberg.